No, I do have like 100 of these already recorded. I usually send out one of my previous ones because I'm never happy with the ones I do. So this is a live 6 hour session, Tuesday, November 4th. And we're now recording. We've literally made it through one slide and I forgot to hit record. So I will, admit my transgression. And yes, I can, yeah, I can send, if I usually send out an 8 hour session to everybody in the email, one that I was particularly proud of. And then, because these take a couple days to process, and then I'll send out this one if you want it. I probably wouldn't. This has already been kind of a disaster. For Illinois, you mentioned we need 8 hours of class. Is that online with you, or does it need to be in person? No, it works with me. You just have to be in 8 hours, but you don't. I mean, the fact that you were here, Vivian, will count for 6. And then you just got to pick up another couple hours either on Thursday or on Saturday. Mariah says, I just started. Are these lives regularly? Is there a set day and time? Yeah. So, yeah, we do these Tuesday, Thursday, and then if you're signed up with Just Insurance, we also do an 8 hour on Saturday. But Tuesday and Thursdays are for the general public. Kareem, your schedule. So, Kareem, are you in a state that you have to do 2 separate tests? Is that right? Because I know Illinois, they like chop theirs up weirdly. Yeah. Okay. Like you do life one day and then health a different day or something like that. Yep. Kareem's an Illinois person. See, that's where, you guys that are asking me all these state specific questions, they're so weird. And I have not personally taken Illinois, although I would like to, and I'm planning on it. I'm planning on taking all 50 states tests. How fun does that sound? Not at all. But yeah, I talked to Justin about that this week about me taking state exams. That way we keep up on it. And I've never failed yet. Close, but I've never failed. North Carolina, I think you only need one test. Yeah, I only had to take one test. I took accident, life, and health all together in one test, 2 hour timed, and it was 150 questions. So got an 87. I never get 100, but I can get an 87. So yeah, use multiple learning methods. Miguel takes the test on Thursday. We'll be sending out good vibes while we're on the live on Thursday. Miguel, I know you've been here multiple times. So master the material, understand policy provisions, contract law, COAC and CUA, my 2 favorite acronyms, underwriting, and state regulations. These are heavily tested. Actually, if you've been in here before, I hate the acronyms COAC and CUA. And I'm such a nerd. I literally think about this stuff when I'm not doing it. And I was driving home today and my son coughed. And I'm like, that cough sounded like the acronym COAC. He's like, bleh. And I was like, that's how I'm gonna help people remember the acronym COAC, is that it sounds like a cough. Sherry says, scheduled to test on the 14th. Matt, your Zooms are making the info stick. I made it 90 on my pretest. Awesome. Man, I love hearing that. I absolutely love hearing that. So that made my insides smile. So I love it. I love it. All right. Yes, you're going to be my new publicist, and you're going to let everybody know how awesome that I am. All right. So again, the key concepts, policy provisions, contract law, underwriting, and state regulations are heavily tested on. Policy provisions and clauses for you health people, Medicare Parts A, B, C, and D. And I've been kind of leaving some of my health people in the dust lately because we've been having so many life-only people. Let me check the poll. Yeah, we are more in here that's life and health. So we're going to mix it up a little bit more today. I created a new study session. So we're going to mix it up. And then ethics and regulation. These are just showing you sections that are heavily tested on. Take practice exams, simulate real test conditions. Practice exams help you identify weak areas and build confidence. Aim for 80% consistently. So the reason that I create targeted study guides is once you get so far into this, you're going to know your strengths. You're going to know the areas that you kind of just have down. I mean, I know mine personally. So yeah. And so then once you know kind of what you've got down, focus on what you don't have down. So yeah. And then pro tip, review why your wrong answers are wrong, not just the correct answer, to deepen your understanding. And then this is a big one. Watch for words like not. We've already heard this, right? Except and always. So it changes the meaning of the question. Read the question and understand it. Read all the answers and understand it, and then answer accordingly. Use the process of elimination. There's another one. Cross out obviously wrong answers first. Now, I know you can't physically cross them out, but cross them out in your brain, and then help you, get down to maybe a 50-50 scenario or get to the right answer. And then get 7 or 8 hours of sleep before the exam. Avoid stress by arriving early. Don't arrive 5 minutes before you have to take the test. You're just going to start off on the wrong foot. Bring your ID and materials. Usually you can have a piece of paper and a pen. And then stay positive and trust your preparation. Thousands have passed before you, and with proper preparation, you will too. And then, so Sarah says hers is on the 26th. I'll be showing up the day before for a refresher here every single time. Well, that's awesome. Appreciate it. I'll try not to bore you to death. And Lakeisha says, can I break down rebating, twisting, and I'm sure you meant reinsurance. Yeah, I will do that. In fact, let me copy this real quick. Because you are correct. I rarely ever get to that in these sessions. So I'm gonna put that here. And when I'm on a break, I will create something specific for that real fast, and we can go over that, because I don't even know where it is in my materials, but I know it's in there, and I know what it is too off the top of my head. It's actually pretty fun stuff. Paulina's taking her test next Wednesday. That's an off day for me. Well, I do other stuff. I do QC on the website on Wednesdays. So, but I'll be thinking about you on that day. Check this one more time. Paulina, I see what you moved over to the chat. That's cool. All right, cool. So let's get into the content here so we can, get as much benefit out of this as we can. I got to go to my news section here. Look at this. This is the first time getting this, using this right here. So again, I want to keep these fresh. I want to keep these relevant. And we're going to be looking at these the first time. I skimmed them real quick, but this will be the first time I get in depth with these. And because I really wanted to mix up different methods, instead of just going through, one linear thing over and over and over again. It was really starting to bore me. So I made up some flashcards. So here we go. In fact, I'm going to start by shuffling. So the definition of insurable interest is financial loss that would occur from the death required at policy inception. So insurable interest is really super important when it comes to insurance. This is life insurance specific. All these are life insurance. I have another that's going to be life and health that we'll go through next, because we have so many life and health people in here. But right now, these are life specific. So again, insurable interest is really important, that at the time of the policy is issued, that there is a financial connection between the policy owner and the insured. So now it doesn't matter at death. So in other words, if you have a married couple, and there's an insurable interest in the beginning, and the husband has an insurable interest in the spouse, then and they get divorced at some point in time during the process, it doesn't matter as long as they had an insurable interest in the beginning. That's all that matters. So that is insurable interest. Face amount. Face amount, also known as the death benefit. The death benefit stated in the policy, the amount paid upon the death of the insured. Face amount or the death benefit, also known as the face value. Basically, you have a insurance policy. It has a death benefit. It has a premium. It has a policy holder. It has the insured and the insurer, all those, and we'll go over all those terms. Reinstatement. See, this is not reinsurance, so don't get confused. So if you have a whole life policy that lapses, sorry, my head disappeared there. That would probably be a positive thing for everybody. But if you have a whole life policy that lapses, you can restore a lapsed policy by paying back premiums plus interest and proving insurability. Yeah, 3 years is the minimum. Some of them do go out to 5 years, but generally it's 3 years that you can restore a lapsed policy after it lapses. So, and then the reason these are on only whole life is because, so basically what happens in a whole life policy, which we will get to in more detail in a little bit, is they have a cash value. And then once the policy lapses, meaning you've gone past the grace period, which is 30 to 31 days or 1 month, we'll get to grace period as well. Then you can restore a lapsed policy by paying back premiums plus interest. You actually don't have to do that. That's a misnomer. You do not have to pay back past premiums. You have to pay back interest. And then you have to start making the premium payments again. Now, it doesn't usually make any sense because again, it's going to be thousands of dollars. Generally, it's going to be thousands of dollars because you got to pay interest back. You've got to start making payments on it again. And it's not cost effective. You have to prove insurability. You have to start your non-contestability period over, your 2-year non-contestability period. It just doesn't always make any sense. We'll get more in depth on this. Again, these are just general flashcards. CVS, well, guess what? We're going to learn this together. I don't know what that is. Oh, cash value surrender. Okay. So I never saw that broken down as an acronym before. I know this as a pharmacy, CVS, Walgreens. Cash value surrender is the amount received when canceling a permanent policy. So again, permanent policies have a cash value. We'll get into that more in detail. So the CVS, that's a new acronym for me, is the cash value surrender, the amount received when canceling a permanent policy. I've never seen it listed that way ever. So that's interesting. Paid up additions. Okay, I know these terms, but I've just never seen them as acronyms. So paid up additions, additional paid up insurance when purchased with dividends. I'm going to breeze through these kind of quickly as just an overview because I would rather get into these more in depth in the content. 1035 exchange. This is a good one because I never generally get to this because it's in the retirement section towards the end. So I'm glad this came up. But it's a tax-free exchange of one life insurance policy for another. So you can basically roll a life insurance policy into another one tax-free, and then that's a 1035 exchange. So that's a good one to know because I rarely ever get that far into the content. Non-forfeiture options. There should be 3 or 4 on the other side here. Here we go. Options available when stopping premium payments. These are on whole life policies, cash surrender, reduced paid up, or extended term. And then we'll go into all those specifically. Again, in the content, I always get to that section. Assignment. There's a couple of different kinds of assignment of life insurance policies, whole life insurance policies, but assignment in general is the transfer of policy ownership rights to another party. And then we'll get into more detailed assignment stuff. This is basically a very broad overview right here. YRT, I don't know. I should start guessing what these are. Yearly renewable term. I've never. This is also called annually renewable term, which that would be ART, and that would be a good one too. It looks like it turned almost all these things into acronyms, which these are not widely used acronyms in insurance. But you have yearly renewable term or annually renewable term, term insurance, which we'll learn about in detail, renewed annually without proof of insurability. So these are mostly your employer-based term policies. And so Vivian says we're allowed to bring materials. And it said, no, you can bring blank piece of paper and a pen or a pencil. They might provide that to you as well, because you can move backwards and forwards through the test. And then you can like second guess yourself and kind of go back. You can say, you can write down like question 33 and you want to go back and review it again. I personally don't do that. I'm a turn it and burn it kind of guy. I don't second guess because that's where I make all my mistakes in life. Mariah said, it just started. Are these lives regularly? I think I already answered that one. And then Sherry says, bring your ID that has a full name and also a second form with your signature to verify your signature. I do not have anything that has all 4 names on it for my signature. What do you recommend? Do you have a passport? Do you have like a W-2 from a previous job? Those are generally IDs that people accept, and those usually have your whole name on them as well. So a lot of people don't know you can use a W-2 as an ID, which you can because it does have like your social security number on it or your EIN number. All right, so let me get back into this. So I'm not loving these flashcards. I think they're actually kind of silly. But we'll go through them anyway, just to, I don't know, make fun of them maybe. There's only 40. We're already a quarter of the way through. So accelerated death benefit. So it allows access to a portion of the death benefit while living if you become terminally ill. For my regulars and my newbies in the chat, if you want to, for a little extra credit here, what life expectancy must you be given to be considered terminally ill by a life insurance company? There is a range that usually the life insurance company gives you in order to be considered terminally ill. Kelsey, bam, right out, or Rakaya, you got it right off the bat, 12 to 24 months. So 12 months would be like the minimum. Lincoln said 69. Is that a joke? Yeah, 1 to 2 years. Good job, everybody. You guys got a good handle on that. So if a doctor basically signs what's called an APS, the age of retirement, you have 69 years left, you're terminally ill. So good job, everybody. That's funny. Around age, saying age around retirement. Yeah, actually it's like 62. So just generally 62 to 65 is most everybody's retirement age. So anyway, but yeah, so there are living benefits to life insurance, and we'll get into more of those as well once we get into the content. I want to get through these cards because I'm not a big fan. So whole life, everything doesn't always work. I try things and they don't always work, but whole life insurance, permanent coverage with level premiums and guaranteed cash value. We'll get into that a lot more depth. Variable life, permanent insurance with cash values invested in separate accounts. Again, we'll get into that in more depth. Suicide clause, no death benefit paid if suicide occurs within the first 2 years. Only the premiums are returned. It's also What's called the contestability period is the first 2 years of an insurance policy. A lot of people get confused that no life insurance pays out a death benefit within the first 2 years, and it's because of the suicide clause. But in reality, it's just suicide that's not covered within the first 2 years. If your death is deemed a suicide and you have a life insurance policy, your beneficiaries will receive all the premiums you paid back, but no death benefit will be paid. Universal life, flexible premiums, permanent insurance with adjustable death benefits. So just know that on universal life, you can change the premiums and change the death benefit based on the performance of the account, which we'll learn more about how that works when we get more in depth into this. I do kind of like the overview side of this, but it makes me want to like drive deeper into the stuff instead of just looking at it as a flashcard. So I'm just out of my what's the APL? Something premium loan, automatic premium loan. Okay, that's one that's kind of used, I guess. APL, an automatic premium loan on a whole life policy. If you go past your grace period, which is 30 to 31 days or a month, and you have a whole life policy that has cash value, the cash value will kick in and pay your premiums and keep your policy in force until the cash value is used up. Let's see here. Let me check the chat real quick. Check it over here real quick. Okay. And then next, a modified endowment contract. This is a good one to get to because, again, this is later on in a lot of my content, so I don't generally get there, especially if I do a session that has both life and health. But a modified endowment contract is an overfunded policy that loses some tax advantages, meaning it fails the 7-pay test. So for your testing purposes, just know that a MEC or a modified endowment contract fails the 7-pay test. For your edification, so you understand what it is more, basically, the government has given some tax advantages to like whole life policies, and annuities also can be under this this heading or this umbrella. And so in order so that people like really, really wealthy people can't abuse the system, they've put limits on how much these accounts can be funded. Again, so basically it kind of levels out the playing field between regular folks like myself and really, really rich people. They can't abuse the system. So basically, modified endowment contract or a MEC fails the 7-pay test, and it would be like an overfunded whole life policy or annuity. Substandard risk. That kind of is what it says it is. A higher risk applicant who pays extra premiums, also known as a rated policy. One thing I guess I do like about this is that, again, it's a good like aerial view of this stuff, that it's really just getting some terms you can slightly become familiar with before we get into the nitty gritty. So, but I don't love it. And practically because I don't like GPO. I don't know. Guaranteed purchase option. Okay. Right to buy additional coverage without a medical exam. Yeah, that has a different term. I can't even think of it right now. But yeah, GPO, guaranteed purchase option. Yeah, no, I don't like that. I don't like these. I know what an MIB is, Medical Information Bureau report. So basically, an underwriter uses one of these in underwriting. It says right here, this is an intermediate knowledge level underwriting Medical Information Bureau. So an underwriter would order this, has general medical information on a potential insured, and it'll tell them, basically you can match up the information on an application with an actual medical report. Medical Information Bureau shares medical info between insurers. So, whether you like it or not, your medical information is out there. Now, you have to sign, or not you, but the client would have to sign a waiver form basically allowing the insurance company to acquire this report, and then they can get this report. It comes from like my chart and things of that nature, and it gives kind of a basic overview of your most recent doctor's visits. Basically, it's going to tell them if you've had blood tests. It's going to tell them if you have diabetes, high blood pressure, height and weight, and things of that nature. So the premium, I think we all know what a premium is. If you have car insurance, you're familiar with what a insurance premium is. It is the payment made to the insurance company to keep a policy in force. Okay, no big thing there. A mortality table. This is good because I never really talk about the mortality table, but it is something that's extremely important. A statistical table showing death rates at each age, and it's used to calculate premiums. So this is what your underwriter is going to use based on the client that you're dealing with about their age and other risk factors. And that's what they're going to use to calculate what their premiums are going to be, using the mortality table. Interest only option. Insurer keeps the principal and pays only the interest to the beneficiary. So this could apply to whole life insurance, or only whole life insurance or annuities. So basically, meaning that whoever the beneficiary is on those accounts, they're going to get only a regular interest payment, and that keeps the top balance on the account, the principal, the same. So we'll talk about that more in greater detail as well when we get to that section. Preferred risk. This is just a risk for determining premiums. A lower risk applicant qualifies for reduced premium rates. So this is where you want your clients to be. You want them to be a preferred risk because they're going to get the best rate. Incontestability clause. We talked about contestability, or the suicide clause, and it's that first 2 years where basically an insurance company has the right to contest benefits or deny benefits. After 2 years, the insurer cannot contest the policy except for non-payment of premiums. And then I'll also add into this fraud. If there's some sort of out and out fraud, they can deny a claim after the incontestability clause or the incontestability period. Decreasing term. Term insurance where death benefit decreases over time, often for mortgage, often called mortgage protection insurance. There's an acronym they could have used, MPI. Mortgage protection insurance. So the term or the benefit goes down over time to match the balance of the client's mortgage account going down. So we'll get into that in greater detail as well. Dividends. Return of excess premiums and participating policies, not taxable. So you have certain types of insurance companies that pay dividends. They're called mutual companies. They pay dividends. So they're basically like profits of the company, and they issue dividends annually. And then there's different ways you can use them. Paulina says decreasing term like debt. Sort of. It's definitely. So I'll get ahead of myself here real quick just to answer the question since it's posed. So with a mortgage, let's see if I can do this here. So you have a mortgage, right? And so let's say you have a 20-year mortgage, and it starts out with a balance of $300,000. Well, as you make payments, you have the balance will go down. You get something called an amortization schedule. with mortgages that show you how your balance goes down. And at first, it's very, very gradual. And then the further in you get, it starts to go down, 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 down. And then when you get close to that 20-year mark, it's way down. Well, with a decreasing term on a mortgage protection policy, the death benefit starts up here as well. And then, so again, this is your death benefit. And this is just a type of insurance policy, okay? So it will also go down accordingly with now that doesn't do that, but it goes down. And so over time, and then by the time it's over, there's no death benefit left. And then also your mortgage is paid off. It's a term policy. So then it just kind of goes away. And to me, I kind of just think they're a gimmick, and I'll explain why about that later. Off-topic question: what qualifies as continued education in Michigan? It is required every 2 years. That's a good question. Once you get licensed in mortgage, or not mortgage, I'm sorry, mortgage too, but insurance, every 2 years you have to update your license, and basically you have to fill out like just an extension application, and then you also have to go through an approved provider and do continuing education, which we also offer that as well. So you have to do 20-hour or 24 hours. Certain states have different requirements for this. There are some states that have bonkers, like I think it's New Hampshire. Yeah, you have to do like 90 hours, some crazy amount. But most states are just normal, and it's 24 hours. So basically like 1 hour a month. But generally, if you're like me, I do mine all at the last minute. And, basically I take 1 week and I do my continuing education, and I get it knocked out in 1 week. But yeah, so it's just, and it's nothing like this. There's no testing involved. I mean, the provider might have like little quizzes just to kind of break up the monotony of the content. But it's not, you don't have to take another test. It's not hard. It's really just about kind of reviewing any updated laws. Yes, you have to purchase CE. It ain't free. Nobody does it for free. It's usually not too expensive though. It's usually like, I don't know, $79 or something like that. But you got to watch where you do it, because some just make it so hard. We make it very easy. So I don't even think we have timetables on ours. You just have to get through the sections, so you can knock out 24 hours. I probably shouldn't put this on record, but you can knock out 24 hours pretty quickly. So the equivalent of 24 hours. So, but yeah, you got to pay for it everywhere. Everything costs money, right? There's no free CE. Now, I do think, I shouldn't say this because it's counterproductive, but if I added health, would that be considered? No, continuing ed is something totally different, right? I'm glad you mentioned this, Paulina. You're a medical coder by trade. CE costs pretty penny. Yeah, so in different industries, like I had to do CE in mortgage, and it was like 8 to 12 hours of CE annually. And obviously I'm only referring to insurance right now. But no, the only thing considered continuing ed is continuing ed. And I'll explain like that and quickly, because you guys know how much I do this, right? Like I constantly am immersed in this. I do 20 hours of these live sessions a week. I do testing in every state. I just did Nebraska not too long ago. I did Michigan a few weeks ago. And I still have to do CE through an approved provider. And I told Justin, I'm like, dude, if anybody should be exempt from having to do CE, it's me, because I am constantly immersed in this stuff. But yeah, you just have, CE is just a thing you have to do. Now you can look around your community or something, and there's like places that will say you can come for a 1 hour seminar and they'll provide lunch or something to get CE credit. Don't do it. It is like a timeshare thing, honestly. It's like, it'll be like a company and they'll start recruiting you. Normally it's like, what is that? I'm not going to say it because just in case any of you are with the company, I doubt it. But, it's like there's like one company that just recruits like crazy heavy, and they'll do like a 1 hour CE to get insurance agents to come in, and then they recruit them basically. So just do your CE online. It's super easy. It's just an annoyance you have to knock out every 2 years. So, but again, I had to do it every year in mortgage. So, one thing I kind of forgot, yeah, bloodhounds. Yeah, everybody wants their pound of flesh. I didn't mention in the beginning. I take two breaks during this 6 hour, usually one at 5 and then another one at 7, about 15 minutes or so. So I just wanted to let you know because we're about an hour away from that first break. You guys can do whatever you want because I can't even see you. You guys can come in and out if you want to go use the restroom, and I don't even know about it. But unfortunately, I'm stuck here in front of the camera, so I got to take short breaks. Let's get through these slides so we can get into some of the meaty nitty gritty. Waiver of premium. This is a provision. Rider, or this is a rider. It said provision on the other side. That's not right. Waiver of premium, rider that waives premiums if policyholder becomes totally disabled. So this is an add-on, which again, we'll go in more detail, but just know that a waiver of premium is a rider or an add-on to a policy that waives the premiums if the policyholder becomes totally disabled. So basically, they don't have to make premium payments anymore, and the life insurance stays in force. Cash value is the savings component of permanent life insurance that grows tax deferred. Never, ever, never, ever market your insurance as a retirement account unless you're talking about annuities. But don't talk about life insurance as a retirement account. Now, it can be that, but there are laws that basically prohibit us from marketing life insurance as a retirement vehicle because it's not annuities though. Those are retirement vehicles. That's what they're for, but not life insurance. But it is a nice thing that you can create nest eggs with. You can say that. You can say, if you're not traditionally a good saver, these are tax deferred growth places where you can put money and your money can grow and it's super safe and it's stable and all that kind of stuff you can say. You just don't say that this is, supplanting some other type of retirement account. It's just an add-on. But in whole life, cash value, or permanent life, which is another name for whole life, insurance grows tax deferred. And the only thing that you would ever pay any kind of taxes on is the growth. And we'll go into that in greater detail further up. Life income option. This would go about annuities or would talk about whole life as well on these. Death benefit converted to lifetime income payments for the beneficiary. Obviously, this is talking about whole life insurance. Basically, there'll be an amount that is bestowed upon the beneficiary, and they will pay a little bit of the death benefit out to the beneficiary for life. Generally, this would be on your more affluent type clients, more money, more wealthy. And then, they're basically, probably leaving money to their children, and they don't want them to have one big chunk all at once. They want to divvy it out over their children's life and make sure they have income for their life. But again, that's life income option. And then the insured, definitely something to know with insurance, is the person whose life is covered by the insurance policy. And it's not always the same as the policyholder. The insured can be different from the policyholder. Like a parent can have an insurance policy on a child. A husband can have an insurance policy on a spouse. But the insured is the person whose life is covered by the insurance policy and upon whose death the death benefit or the face amount will be paid. Underwriting. I spent 3 years as a mortgage underwriter. I look back on it very fondly. I really enjoyed doing that. Didn't actually want to leave, kind of was forced out through mass layoffs at a very big bank. And I don't know, that's a whole nother story. I'm going to try to stay off rabbit trails as much as possible tonight. But underwriting is the process of evaluating risk and determining premium rates or policy eligibility. Now, one thing I did not do, I did not determine people's interest rates when I was a mortgage underwriter. I just determined if they were eligible. But a insurance underwriter will determine the premium rates and their eligibility. And also keep in mind when it comes, if you've ever dealt with underwriting in a different industry, insurance underwriting is quick. You're talking about like 72 hours, not, weeks or sometimes months in mortgage. Miguel says agents are underwriters as well. Yeah, in theory. So basically, what they say is that as an agent, you are a field underwriter. So you're kind of the first set of eyes on the person. Now, you don't make any final determinations. So that's really just a, kind of a, turn of phrase, I guess you might say, because again, you might be the one like physically actually sitting down with people or, on a Zoom call with somebody as the client. And so you're actually you're the first you're the first wave of defense. So you're taking the application, you're asking the questions, you're helping fill out the application or filling it out yourself. And a prime example of this is if I'm going to do this from a Zoom call standpoint because we're on a Zoom call. I wish I had one of these things with me, but I don't. I wish I had a candy cigarette. But if you are with a client, I have a marker. That's the best I can do. If you're with a client on a Zoom call and they have filled out the application and you're going over it and they say they're a non-smoker, but you're on a Zoom call with them and they're doing this, they're smoking, you're going to want to change that application answer over to smoker so they get an accurate underwriting. So that's one function that you would do as what's known as a field underwriter, is that you would correct anything that the potential insured misstates. And yeah, so there you go. But yeah, it's a good question. It's a good thing to bring up. I have seen like a question about that before on a test that an agent is known as a field underwriter. I don't see it often, but it does exist. So good question. Standard risk. This is your average risk applicant who qualifies for standard premium rates. This is Mr. Joe Average. Nothing, has some issues, nothing too big. This is your, the girl you meet at the bar that's, no red flags, no real major red flags, but obviously not perfect. And they qualify for standard premium rates. That is a standard risk. And again, that's kind of self-explanatory, right? And then the beneficiary we've talked about a little bit. The person that's named on the insurance policy who will receive the death benefit. There can be more than one. It's the person or entity who receives the death benefit when the insured dies. So, maybe you've been a beneficiary. Maybe you've had an account, a life insurance policy before, and you've named beneficiaries. We'll talk more about that in detail as well because there's different kinds. But again, this is just a flashcard overview. Convertible term. I love convertible term. If you've been in my lives before, there's two kinds of insurance policies that I love to sell. Someone can put the other one in the chat if you've been here before. Convertible term is one, and the other one is what? But a convertible term is a term policy that can be converted to permanent without a medical exam. So, basically you get a convertible term policy. Maybe it's a 10-year, maybe it's a 5-year. So at the end of the term, you can convert it to a permanent, also known as a whole life policy, and you don't have to prove insurability. So no one answered my question. So good. You'll hear it for the first time when I talk about it, when I get into the content. Grace period. Kareem got it. Return of premium insurance. Yeah, that's my favorite. That's my favorite. I'll still talk about it. That way everybody can hear my story. A lot of times people say that my stories are the main thing. That's, someone asked, I think it was Lincoln said, what if you just take this, my live session, and you take the test tomorrow and you do nothing else, I guarantee a one, and maybe it's return of premium. But I can't guarantee what questions are on there. So that's one is all I'll give you. So grace period. Shamel says it gives a different approach. Very much appreciated. No problem. I really enjoy this. There's a saying that if you find something you love to do, you'll never work a day in your life. And I do love to do this. I love to help clients with insurance, and I love to teach potential licensees, um, how to pass their test. So, and I feel it when you fall short. I feel it. So just know that, I'm invested. I'm invested. So yeah, I do a lot of things. Yeah, I am full-time remote, Miguel. I have been full-time remote for the better part of 10 years, more than 10 years now. I did have a short stint where I went to work in a factory for a little while, and I hated it. It was third shift. I've told this story before. I'll get into my first rabbit trail because I do like to mix it up. I don't like to just sit and drone with the content. I do like to tell stories. This really doesn't have anything to do with anything. Yeah, and this is a way that you can, this industry, you can stay remote and do really well, and then be there for your families and whatnot, and have a kind of a life that you control. And I went to a factory, and I'm telling you, I'll give you this little story real quick. Worst experience ever. It was pretty decent money, honestly. But they made that experience so miserable. Like, it seemed like every day they just plotted and were like, how can we make it more miserable today? Just moving around the building was miserable. You had multiple checkpoints that you had to go through, security. It was hot and miserable. Paulina asks off topic question, and I have ADD, by the way. So when I see questions, I can't help myself. I have to try to answer them really quickly. You can make as much your first year as you really want. It depends on how much you're able to work. Depends on the company, leads, all kinds of different stuff. I've seen people make six figures their first year. So it's really what you put into it. And that's the great part of it. It's all up to you. Miguel says, I'm working at UPS till I pass my exam. So I feel you. Yeah. And I never did work at UPS, but I know people that did. But this place, it was probably similar, honestly. We get to like 106 degrees in the factory. It was up and down ladders. But I'll tell you what happened. And the reason I'm not there anymore for, lack of a lot of, reasons. It was when we were just developing this, there wasn't enough to keep me on full time at the time. And my license was in limbo at the time. Not anything anybody needs to worry about. I didn't do anything wrong. I just let it lapse. And so I was working at this place until this kind of got more up and going. And so I was working one night. It was 2 o'clock in the morning. It was actually a Monday morning. And I drove these little power jacks, like little fork trucks, but you didn't ride on them. You just pushed them. And so I was waiting to pick up it was a server rack is what it was. They were about 8 feet tall, and they weighed a lot. And we had to use these power jacks to lift them because they were so heavy and move them around the building. Well, I was waiting to pull into one, and then there was a guy behind me also on a power jack, and he was waiting on me to get in mine, and then he was going to get in one himself. So as he was behind me, he was creeping up on me, and I could kind of feel like I'm getting close. And I turned around and looked at him and tried to wave him off, like, hey, dude, why are you getting close to me? You shouldn't be anywhere near me. Well, he creeped up. He wasn't paying attention, and he ran into my left foot with that pallet jack. Now, to put this in perspective, these things weighed like 1,500 pounds and they were powerful. And I always explain it to where like it's like getting hit with a shopping cart, but the shopping cart weighs 1,500 pounds. So I had to go to the nurse's station. No, we had to wear composite, but he hit me in the back of the foot, and so there was no protection back there really, and it really wouldn't have mattered. He just rolled up over my heel basically, and I ended up in the nurse's station. My foot swelled up, and basically I was off the rest of that night. It was 2 o'clock in the morning, and I got off at 6. It was a 12-hour shift, 6 to 6. And so for the rest of the evening, my foot was propped up and on ice. And long story short, I worked 3 more shifts after that, and then now I've just got a big workman's comp case that I'm waiting, that I've been waiting for a long time. But and I can still walk and everything. Everything's fine, but it's something I'll probably live with for the rest of my life now. The pain, and it's stupid. It never should have happened. It wasn't my fault, and it was because of that job. So anyway, yeah, I'm just waiting all that to be. And so this works perfect for me. Rosa says, if we work from home, how is the training done? Like this. Yeah, just the same as this, like these Zoom calls. So yeah, insurance probably is the biggest user of Zoom, or like online, Teams or whatever, of the world. Now I know mortgages really caught on to using Zooms as well, so you got to get really adept at using Zoom. Now I'll help you out real quick because I see some people still have host and panelist. um, I, I'm a teacher, Paulina, so I teach you how to pass your license. Your companies and your mentors, they will help you with the leads and stuff, because every company is different. We have 44 people in here, and I'm sure everybody has a different answer for that. So, but yeah, I'm a teacher, so I'm here. I'm your study buddy. I can't help you with that one. But if you want to change your drop down in the little chat box to everyone, then you'll be able to see everybody's chat. So let's get through the rest of these flashcards. I'm not a huge fan of them, so I want to move on to my regular content because I don't like these. Term life, which we're going to cover. Temporary coverage for a specific period. No cash value, pure death benefit. That is term life insurance. Kind of self-explanatory, but we'll get into more details when we get into the content. Policy owner, we talked about this, the difference between the policy owner and the insured. The policy owner is the person who owns the policy and has all of the rights. They can do all the different things with the policy, including naming beneficiaries. And then COAC, here we go. One of my least favorite acronyms. Competent parties. Now, COAC is a contract concept here. So it's an acronym to help you learn the parts of a contract. Competent parties, offer, acceptance, and consideration. So it's the elements of a legal contract. So, if you like that acronym, more power to you. I'm not a big fan. COAC. And then lump sum. It's another payout of a life insurance policy. Now, this could be term life or whole life. It doesn't really matter. So death benefit paid in one single payment to beneficiary. This is mostly how insurance proceeds are paid out, is a lump sum. It's just if it has $100,000 death benefit, $100,000 is paid out to the beneficiary. It's usually how it works. And then a fixed period option. This is the death benefit paid in installments over a specific period of time. So say the death benefit's $100,000 and they pay it out 25% over the next 4 years. So after 4 years, the whole death benefit's paid out, but for some reason, whoever the insured was or the policy owner, they wanted it doled out in chunks. Maybe they don't trust their children with big chunks of money or their family. And that's those. Probably never use those again, so you guys are going to be the only ones ever to see those. But actually, am I going to do this? hold on, because I made up, because we have a lot of life and health people on here. Let me go back to the this real fast. Where did my poll go? There it is. So yeah, we had more than half the people are life and health. So I will read Lakeisha's message. How long will I have access to me? They said my course was over November 8th, but it says November 28th, and I had complete pre-licensing part, and it's another part. Do I have to finish that part? Yeah, but basically access to me forever. So during the week, again, Tuesday and Thursday, if you guys are really a glutton for punishment, you can join us every Tuesday and Thursday. And then as far as email goes, I will never turn you away. So basically, I guess you buy this, buy this material or this website access, and you get a free mat for life. So I'm sure my wife would turn me over to anybody at any point in time. Lakeisha says, what's the definition of the grace period? So a grace period is the amount of time that you have to pay on your premium for insurance to keep your insurance policy active, and it's generally 30 to 31 days, and or it could also be a month. So yeah, it's a good deal. I should tell Justin, like, whenever he signs people up for the website, purchase the website, get a free mat. So, and again, I do take this very seriously. People in here can attest to the fact that I will respond to your emails. Every once in a while, I mess up and something happens where I lose the email addresses, and it always bugs me. So I try to take those down. Like when we take a break, I try to go through the chat and copy all the email addresses, when I take a break real fast. That way I don't lose them in case because the live like keeps the chat for some reason, like when you're recording, but for some reason it only keeps a certain amount of it. And it's super weird. I don't know. Like I've lost a lot of email addresses, and it really bugs me because again, I do promise to send out. But if I like the other day, this is the dumbest thing that ever happened. I don't know if anybody was here, but I was doing a live. We were really close to the end, maybe had like 15 minutes left or something like that. And I was messing with my marker, and I was like spinning it because again, I have issues, and I'm always, my hands have to be busy doing something. And I have a little power button on the corner of my laptop. It's like that big. And I dropped my marker, and it landed right on the power button and shut my laptop down. Obviously, it shut the live down. And so on that one, I think I lost. It was kind of a smaller group. I think I lost a lot of the email addresses that I had that day. Kareem was here for that. Yeah, that was super embarrassing. And some people said they thought it was their fault, and I should have just went with that and blamed them. But I took credit for it, my stupidity. And so yeah. Miguel says he didn't want to teach. Don't listen to him. Yeah, right. That's not true. I bear, like, sometimes I'll give back time and not even take my full size breaks because I feel like I want you guys to get as much benefit out of this as possible. Have like this, my mom gave me this like serious guilt complex, that I live with. She's passed away 2 years ago, but her guilt, her voice still speaks to me in my head. So I'm always trying to give and give and give. And so yeah. And you guys can attest that fact. I know you will. All right, so we're going to do some insurance acronyms here, and this is a lot of these are health related. So I know I have a lot of health people in here, and I don't want to leave you guys behind, but these will be health and life. And then if you're just life only people, you can shut your brains off for a little while, but I would definitely stick around. But we're going to get some health. And then at the end of this, just to kind of give everybody a flow of how this works, one thing I'm not going to ever probably stop doing is we're going to do practice exam questions towards the end, probably the last hour or hour and a half. And these are going to be exactly the questions that you could potentially see on your exams. And we'll go over content through that as well. We won't just answer the questions and move on. We'll actually talk about them a little bit. They usually have like little explanations at the bottom after we answer the questions, and we'll do it that. And everyone seems to have taken to that and really is getting a lot out of it. So I'm going to keep that as part of my rotation on my 8-hour sessions. I think I did almost 2 hours of it on Saturday. So yeah, this is what I do. All right, so we'll do these, and these have and I don't know if it's me, like I'm flipping out here. I've had too much caffeine, but I think the HMO is moving. Does everybody see it moving? Is it like pulsating? If so, that's really cool. Either that or I'm having a stroke. I don't know. One of the two. One of the two things is happening. I think it is. It's actually moving. So anyway, that's kind of cool. Okay, Miguel confirms it's moving. I'll start to get a little dizzy. So don't look straight at it. You're gonna get dizzy. So HMO is it's a health term. Okay. So for those of you that are doing life, again, you can kind of shut your brain off right now, but I am going to help you understand. And it, man, in the peripheral, it's killing me. Yeah, it's got, yeah, here you go, Miguel. It has a pulse because it's doing health. But when you see it in your peripheral, it's like really disorienting. So HMO stands for Health Maintenance Organization. And I'll explain a little bit about it, because this will cover some of our health topics right here. So basically, a health maintenance organization is used as basically a health insurance type. You have HMO, you have PPO, which we'll probably learn about as well. And they have a different slant towards insurance. So health maintenance organizations, one thing that they do is they lean more towards preventative medicine. So preventative medicine or preventative maintenance, like with a vehicle, with a car, preventative maintenance is like regular oil changes, inspections. If you have an older vehicle like I do, it actually has like grease fittings where you actually grease up certain points on the vehicle. That's part of maintenance. So, even washing a vehicle is part of the maintenance. Well, HMOs, health maintenance organizations, these are about maintenance, meaning they want you to go to the doctor. So you have to have a primary care physician in an HMO. And you also have to stay in network in an HMO. You can't, if you go outside of network with an HMO, you have no coverage. They will pay for nothing, meaning they have a network that they work with, and they make you stay in it. So that's one of the differences between an HMO and a PPO. The other thing would be is if you want to see a specialty doctor, like one of the things that I've had to do with my workman's comp case is I've had to go to a foot and ankle doctor. Someone last time didn't even know there was such a thing, a doctor that just works on feet and ankles. But I can actually, it's really close to my house, and it says it's called, like, the building is called like foot and ankle doctor. Like, they went really simple, which I love it because I'm a simple person. So I'm like, hey, that's the foot and ankle doctor. And I had to go there to have my left foot and ankle checked because that's when it got hit. So in an HMO, now I don't have one, I have a PPO. So I did not have to get a referral. But if you have an HMO, then you have to get referrals in order to do a special, like an ear, nose, and throat doctor, or an orthopedic surgeon, or a foot and ankle doctor. So a lot of times people have these health plans and they have no idea like what the difference is between their health plans. But if you try to go to the doctor and they're like, well, you need a referral to come here, then you have an HMO. So there you go, something you can win a bar bet with. Okay, so there we go. We're going right into PPO. Let me see if this one moves. It also moves. A PPO is a preferred provider organization. Emphasis on the word preferred. There is a network for a PPO, but you can go outside your network. So it's, you can go where you prefer, right? That'll help you. You can go outside your network. Now, they may cover less if you go outside the network, but you can choose to do that. You can also go directly to a specialist if you want to. If you need to go see an orthopedic surgeon, or if you want to go to the foot and ankle doctor or an ear, nose, and throat doctor, you can go straight there if you feel you need to. You don't have to get a referral. The other thing about a PPO is you do not have to have a primary care physician. You can just go to whatever doctor that you want. You don't have to name one. So if you're ever filling out insurance paperwork and the insurance paperwork basically says they need to know who your primary care physician is, you pretty much know you have an HMO. But a PPO, you do not have to have one. So preferred is the key term there. POS, it's not what you're thinking. It is, and I'm gonna so I'm a bit of a show off. So I'm gonna say what this is before I flip this. And again, I've never looked at these. These are new. My flashcards are new. It's a point of service plan. Bam, point of service plan. Again, it's not what you were thinking. So basically, it is specialized. It's more a combination of PPO and HMO. This would be like your Cadillac type insurance plan. If you like have a plan through work and there's like a top plan that's the most expensive that nobody picks. I mean, I know I wouldn't. I always pick the cheapest one just so I had, some health insurance to provide. But I always pick the cheapest plan. But a point of service plan is like the one they probably have for executives in the company because it has all of the best aspects of a HMO and a PPO. So it does have a network. You do have to have a primary care physician, but you can go outside of the network and it just pays a little bit less outside the network. So that's a POS or a point of service plan. And these are all health terms, by the way. An EPO, not sure about this one. An exclusive provider organization. Okay. So I didn't know the acronym, but I know what it is. So typically what this is, and I don't think you're going to see this on a test, to be completely honest with you, but an exclusive provider organization is an insurance plan where you have one choice. You got to go to that one choice. Like an employer will basically fund a insurance account, and you've got to go, like, let's say on a dental plan or something like that, there's one dentist covered and you go to that one dentist, or there's one health group covered, like Mercy Health Group or whatever, Christ or Jewish or whatever. So that's an EPO or an exclusive provider organization. I've never seen that on a test, but maybe. Obviously, it's part of it. All right. So Medicare Part A, you health people, these are the ones. These are your social insurance things that you got to learn. And so when I'm talking about insurance, when I'm doing these sessions, you have life. Life insurance to me is more what they call conceptual, what you'll call conceptual. We're learning the meaning behind things or the reason behind things helps you get to the final answer. But with health specifically, it's just a big vocabulary test. Now, it's all a big vocabulary test, but with health especially, you know the terms, you know the definitions. And it's really just about studying. So Lakeisha asked a question. I would like to know, do you know when you will know how much you will charge for one-on-one time and hour? You don't know. Answer now. Can't, since you're in the health part. For one-on-one sessions. So that's so that's what I'm trying to work on. They're already out there, I think. I'm really confused because I've got to talk to Justin tomorrow about these. But so the one-on-one sessions, I think the regular price of them was like $109, but the special is $79. But I'm trying to get him to because they're for an hour of my time, like exclusively. So I'm gonna try to get him to roll out uh, basically buy a 1 hour session, get an hour for free. So that's something that I'm trying to offer up. And because I don't even know if it's officially been rolled out yet. There's a link to it, but I don't know how well it's being like marketed yet. So I'm talking to him about that tomorrow. So I can get back to you on that. Lakeisha, do you have your test scheduled yet by any chance? Or do you know when you're taking your test? Because if I've emailed you before, you do have a link to the one-on-one. But again, I don't know how it's working exactly yet. Uh, Recently, I haven't had anybody sign up for them, so probably because they're cost prohibitive. That's what I want to try to do away with. Okay, so you're new here. Are you the same person? Is that two different? You're messaging me from a different place. I'm so confused. Anyway, I'll get back into the thing, but when I do send out the materials, I do send out a link to the one-on-one scheduling. I just haven't done one recently, so I don't know exactly how they're working. I know you have to schedule them in the future because I can't do anything same day. So again, I don't know how it's working, but I haven't done one in a while. So Medicare Part A is hospital insurance or basic Medicare insurance. So that's Part A. And then Medicare Part B, I was hoping that they would do this one next, which is medical insurance and Medicare. So it's more comprehensive. So Part A is just basic hospital insurance. Medicare Part B is more comprehensive, and Medicare Part B has a premium. So you pay premium, you kind of choose like what you want covered, and you get to choose it. Medicare Part A has no premiums. Um, Medicare Part C, which is also known as Medicare Advantage plans. Maybe some of these people or some of the folks that are in here are training to work with selling Medicare Advantage plans. Part C, Medicare Advantage plans. So, in order to purchase a Medicare Advantage plan, you have to already be enrolled in both Medicare Part B and Medicare Part A. And then Medicare Advantage plans are managed by private carriers. And giving you basically all the knowledge that I can off the top of my head of all these things as we're going through these flashcards. So in your area with Medicare Advantage plans, which is Medicare Part C, you will have like a local provider. In my area, we have United Healthcare and you have Cigna. And most every kind of area has their own, and then those people basically provide the insurance to people that choose them. Lakeisha says, I have not taken my exam yet. Still want to study, trying to pass on the first try. Thanks for the information. Yeah, no problem. And that's what I want everybody to strive for, is passing on your first try. And I don't want you guys jumping the gun, trying to schedule it too early. Like I've said before, you need to be probably scoring 85 to 90 on your practice exams to make sure that you're going to get at least a 70 on your state exam. And again, it's not foolproof, but I'll do everything in my power to help, push you over the edge. So with, again, Medicare Advantage plans, also known as Medicare Part C, they're managed by private insurance firms. Sometimes they have a premium, sometimes they don't. If you were looking to do something in the health field, I know we have somebody that's in coding here. That would probably be a natural thing to move into, is doing Medicare Advantage plans. Now, you can be an independent Medicare Advantage agent, although I wouldn't recommend it starting out. There's a lot of rules and regulations, and there's a lot of mistakes that you can make that will get you in hot water when it comes to Medicare Advantage plans. And the thing about it is, if you think about it, when you're dealing with clients that have them, it's probably the easiest sell ever. And reason being is because there's generally no premiums on them. They have different ones have all kinds of different like advantages or features. You can have one that has A, B, and D. So they have drug coverage. They can provide like gift cards for groceries, different kinds of stipends where you get a card and you can pay for your prescriptions and stuff. I mean, there's crazy Medicare Advantage plans out there, and the companies, they push them because it's guaranteed money from them from the government. So that's why your United Healthcare's or Cigna's. That's why they're pushing these, because they know it's guaranteed money they're getting from the government, and and that's why they add all these different features. And basically, you're going to call someone who's on Medicare already, and you're going to talk to them, and they're going to be happy that you called, and they're going to want to talk to you. And then, if they, either already have a Medicare Advantage plan or they don't have one yet. And it's, again, when you tell someone, I can offer you all these things that you probably don't already have, and it's free, it costs you nothing. You can't close that sale. I don't know how to help you. So Medicare Advantage plans. Part C. Part D, pretty easy. D, drug coverage. So prescription drug coverage. Paulina says Medicare Advantage is cheaper for patients than traditional Medicare, but in the end of the day, the care is delayed due to pre-authorization. Not necessarily. That's conflating two things. What we just talked about with PPO or HMO, because you can have a Medicare Part C plan that would be a PPO. Now, you're correct. If your Medicare Part Advantage plan is an HMO, then yeah, you're going to have a problem with that because you have pre-authorization. But it isn't like you're the only person dealing with that. It's everybody that has an HMO. But Medicare Advantage it's pretty awesome stuff, and I wouldn't shy away from it in any way if you can. And I definitely would, if you have elderly parents or something that have traditional Medicare, I would push them towards a Medicare Advantage plan by all means, because there's you Part D right here is automatically in it. If you have Medicare Part A, you're someone that has Medicare Part E has no drug coverage. So they have nothing for prescriptions. So meaning they have to pay out of pocket for all their prescriptions. But if you get a Medicare Advantage plan, then you can have Part D included in that, and then you get some coverage for your. But yeah, you're right in a way. But again, I wouldn't shy away from it in any way, shape, or form. But Part D, easy to remember: drugs, prescription drug coverage. I have no idea what this is. I don't know. Oh, Medicare Advantage prescription drug plan. That's a weird way to say that. It's actually just Medicare Part D. We already just covered it, so that's nothing. HSA. Oh man, I love talking about this because when I was working regular jobs and I would get either an HSA or an FSA, I never understood how it worked. I mean, I'm a guy, so I'm not going to read the, whatever they give you with it to tell you what it is. But now I just know it off the top of my head, which is totally amazing. So an HSA is a health savings allowance plan or a health savings account. So basically I'm going to grab a drink here real quick, and then we're going to take a break in about 8 minutes, or I'm going to take a break. My throat's closing up because then I do this too often, and then my wife says I talk too much to her, so I'm always talking. So health savings account. So with certain types of insurance plans, usually your bronze plans, you either get an FSA or an HSA. So a health savings account are definitely better because basically it's money. They also call these TTA plans, which is triple tax advantage, which I don't know, I just like saying it. It reminds me of when they would like introduce monster trucks and they would say Sunday, 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 the monster trucks are coming wherever. Triple tax advantage health savings account. So the thing to remember about a health savings account is that's your money. And at the end of the year, you don't lose it. So with an FSA, which is probably the next slide, I'm going to guess, you lose it. But a health savings account, it continues to grow as long as you're not using it. And you can use it for more things, different things. Generally, if you go to a pharmacy or grocery store or whatever, and you get some medicine, some sort of things that are covered on the HSA, and you go to pay the bill, the HSA will go through and pay for everything that you bought. I've literally bought football cards with my HSA account before because they had some at Walgreens and I was buying my medicine and I bought some football cards and the HSA covered it. So HSAs are much more flexible. They continue to grow. It's your money. If you leave the company that offers the HSA, it goes to a private account and it still is your money. So you get to use it until it's all gone. And then an FSA, flexible spending account, is also goes with like a higher deductible type insurance account, medical insurance account, and basically you can only use it for certain purchases that are medical in nature. If you go to a pharmacy, they'll have like a little tag next to items and it'll say FSA eligible. So meaning you can use your flexible spending account to purchase that item. And then, again, with that, the flexible spending account generally starts over. So you use it or lose it at the end of the year. And then, and it's not always just like December. Sometimes it's a fiscal year. But generally December. And that's why a lot of people will go and then they'll like buy a bunch of vitamins or something at the end of the year or a bunch of cold medicine to use up their funds in their FSA. HRA, not sure. Health reimbursement arrangement. Oh, yeah. So this is another private insurance account. And I'll be honest with you, my weak area is health. For some reason, I now do better on my health tests than I do if I just do health only as opposed to life only. I guess it's from teaching these classes, even though I usually don't go into health all that much. But health reimbursement arrangement, it's a private health plan where you pay for the services out of pocket up front, and then you basically turn in the receipt and get reimbursed for it. Generally, again, a private insurance plan, they love these because they don't have to go out of pocket. You do, and then they're hoping that you forget to request the reimbursement. So MSA, a medical savings account. Again, I've never seen that on a test before, so I wouldn't worry about that one. HDHP, high deductible health plan. When will they talk about life insurance? So they're kind of peppered through these 31. And then once I'm done with this slideshow, probably at about 5:30, I'll go back into life specific stuff. But these have life questions peppered throughout, but the front side of this is mostly health. So we have half on here that's doing health, so I don't want to leave them behind. But yeah, so the high deductible health plans is something we talked about earlier. These are the ones that they pair with the FSAs and the HSAs. Basically, it's anything that has a deductible over $1,500 per year. So is considered high deductible, although that number should be going up because I see high deductible plans that have $5,000, $10,000 deductibles. But basically, it used to be the threshold was about $1,500, and then that I like them personally because they open up the ability to pair with an FSA or an HSA, and definitely HSA is more desirable, which we've already covered. AD&D. This is a life one right here for you. Question about life. So AD&D is a rider, accidental death and dismemberment rider, which we'll get more in depth into riders in a little bit. I'm going to get through. So I said I was going to take a break at 5, but I'm going to get through all these flashcards and then I'll take a quick break. I'm feeling good, so I can give back some of my time today. I don't have any issues. So accidental death and dismemberment. So it's an add-on to a life insurance policy that in the case that the death, thank you, Shima. Thank you for the kind words, Shima. So in the case of accidental death, it increases the death benefit for somebody. Sometimes it's double or triple the indemnity based on whatever policy it is that you provide someone. So, why would that be important? So when someone dies as a result of an accident, that throws a family into turmoil. Obviously it's not, nobody's prepared for it. It's not expected. So when you're offering these riders, like this would be a good one if you have a client who, let's say, they're like a traveling salesperson. They drive a lot. At one point in time, I was up to be the regional sales manager for Shaw Flooring, and I got offered the position, but I didn't take it. But I would have been driving between where I live. I'm in Southern Ohio, between Southern Ohio, Michigan, Indiana, Wisconsin, and Kentucky and Tennessee. I would have been doing a lot of driving. So in that case, an AD&D policy would have been a great thing, because you're way more in danger driving than you are flying. We just hear more about plane crashes than we do car crashes, but car crashes happen a lot more than a plane crash. But again, if you travel a lot, if you have a client and they travel a lot, then adding an AD&D rider to their policy is going to be something that's important. And again, if you are learning about your client and you're picking up on things like this, they're going to appreciate your professionalism, that you're not just out to increase these policies for your own benefit, that you're really looking out for them. Because what a rider does, it does increase the premium, but it's for a purpose. And again, if it's something that is, specific to them, and you're saying, well, look, you're a traveling salesperson, or you're a regional manager or something, this is going to be super important for you, because, you never know what can happen. And you better get used to talking about death with people. If you are shy about talking with death with people, whether you're doing health or life insurance, it doesn't matter. You got to get over that. Generally what I do to break up the monotony in these live sessions is I usually tell a near-death experience that I have. Some of you multi-timers on here probably have heard either my Winnie the Pooh story, or my RoboCop gun story, or my Mustang Cobra story, because I use my stories, my near-death experiences a lot to connect with people when I'm, on a sales call. I'll use anything. It doesn't matter. If I hear a dog barking, I'll talk to them about, yeah, great. Those are my classics. Yeah. And someone said in one of my live sessions that I should do a podcast, which I actually do. I haven't recorded any recently, but it's called Without a Pass. I should start providing links to that in my emails with all my study materials. But my emails are getting completely ridiculous. But yeah, I'll do that. I'll put a link. It's called Without a Pass. It's a friend of mine. He and I went to the same Baptist seminary. I went in the mid 90s and he went in the mid 2000s. And it's like one of the most conservative colleges in the country, and it's a crazy place. And so we tell stories about our experiences when we were there. And people say, "Well, nobody's going to listen to that." Well, we have tens of thousands of streams of our podcast, so people have caught on to it. I'm not famous or anything like that, but um, people, I always say, like, like on Lifetime in different places, and I actually have a friend who had a Lifetime show for a while. Um, Actually, it wasn't a while; it got canceled like almost immediately because of the subject matter. But that's neither here nor there. But like the shows like Leaving the Amish or 19 Kids and Counting, that's kind of like what our show is we basically talk about our experience at the, and I don't do clickbait, I'm not a clickbait person, but at the world's most conservative seminary. So but anyway, that's you know I said all that because I was talking about being a traveling salesperson, but um, I did. But again, learning about your clients, is important. And I was talking about near-death experiences, and I'm rewinding. My brain rewinds, by the way, and that you need to get used to talking about that. So that's why I do that. I'll tell you a new one right now. This is a quick story, and this is actually true, and I have a kind of a follow up to it as well. But I was working in an office when I was in mortgages, and at the time, I was working like yes, Shamel says, be more personable. Stories help to sell. It's true, very true. Anything you can do to create a rapport with whoever you're talking to, it definitely helps. But I was working at a company, I was working like 80 hours a week, and I was I was not doing well taking care of my health. I was going to the gym. I was taking 800 milligram ibuprofens. So here's a little health tip for you. Don't abuse ibuprofen because it will tear your stomach apart. And again, I was working a lot, and I was working out a lot, and again, I had 800 milligram ibuprofen. I had a big bottle of them, and I was taking them like candy. Well, I ended up, yeah, it's good advice. I ended up getting several bleeding ulcers in my stomach, and I was at the office one day, and I won't give any gory details, but I collapsed at the office. I ended up in a pool of blood, and I was being escorted to the hospital in an ambulance. And I was awake when I left, and it's kind of like the player in football being carted off the field. I was giving my coworkers thumbs up and everything. I see it. Check the Q&A. So glad I'm here because I connected with you via text. I have to see if your emails are going in my junk pile. Oh yeah, cool. So I usually don't do this, but I'm going to give you my email address here real quick in the chat, in the Q&A. I usually don't do this because I just don't want to get 80 emails at one time, but since you're having trouble, I'll go ahead and send you that. Because I definitely want to connect. But anyway, I was on my way to the hospital, and at one point in time, I remember being above myself. And I'm looking down at myself, and I can hear the EMT yelling at me, stay with me, stay with me, stay with me. I couldn't answer him, but I'm looking down on the scene, and I didn't see Jesus and all this kind of stuff, but I know, somewhere else. And someone explained it to me kind of later on. They said basically I was behind the veil, because I remember there being, like, this is so dumb, like, to say it, it sounds cliche, but there was a bright light. It was very warm and peaceful, and I didn't see anybody or hear anybody or anything like that, but I was definitely not in my body. Okay. So But again, I could see myself, I could still hear, I was still near it. Um, and I just remember the peace and the calm. And then all at once I was back. So I didn't really know what happened. I wasn't super aware of what happened. And then I had to get my paperwork from the hospital because it happened at the office. So I had to send some paperwork up to our corporate about it. And when I got my folder at the hospital, I realized that I had to be resuscitated twice. So I had flatlined basically, and I had to be brought back a couple times. So that was again my near death experience. So the follow up to this was I was connecting with someone else. Yeah, I'm good now. I don't take, I never touch ibuprofen. I don't touch it. Um, yeah, I take Tylenol sparingly because I know that's got some dangerous stuff too. But yeah, thank you for that. But it's, anyway, someone that I connected with as part of this situation, they had a similar thing. They were actually undergoing surgery, and they had the same situation where they were looking down at themselves, and they couldn't, they obviously couldn't speak. They were in surgery, but they were looking down on themselves. And this is the crazy part, and this will give you a little bit of chills. So if you don't believe in the afterlife, there's way too much evidence that there is some sort of an afterlife. And this situation where this girl, she was in there having surgery or whatever, she had to be brought back from the surgery. She flatlined a couple times as well. And after the surgery, a couple days later, the surgeon met with her to see how she was doing, and she said, "I want to ask you a question." And she said, "Did you recently lose a scalpel?" And he said, "Yeah, I did." He goes, "It was super weird. I was in the middle of a surgery, and I lost a scalpel, and I had to have one of the attendings get me a new one." And she said, "I know where it is." And he's like, "What are you talking about?" She said, "During my surgery with you, I could see myself, and I was above my body, and you have a cabinet in the whatever the OR where we were at, and it's very close to the ceiling." And she said, "If you go in there right now, on the top of that cabinet, you'll find your scalpel that you lost." And so he was very spooked by this situation. And he did go in, and he reached up because you couldn't even see on top of it. And he found his scalpel on top of that cabinet. And I was like, well, that is crazy. Because I remember I could literally see the EMT, and I could hear him screaming at me, but I couldn't answer him because I was down, I was above, and I was looking down. So I really connected with her story, and it was really spooky, that happened. So again, one of my near death experiences. I've never told that in one of these lives before, so you guys are the first to hear that one. And some of them are funny, and some of them have a point. That one really doesn't have a point, except it happened to me. And I guess the moral of the story is don't abuse ibuprofen, and that I believe there's some sort of an afterlife. So there you go. So that's AD&D. All that from AD&D, right? COB, no idea. Coordination of benefits. There you go. I don't know that one. So COB, coordination of benefits. I'm sure it's a health term, but I don't know. Oh, claims, coordination of benefits. Can't expand on it because I don't know it. EOB, explanation of benefits. So an EOB report, I do know this one. Basically when you get a health plan, they give an EOB out that covers the plan. And then with life insurance, they basically give something out similar as well that explains how the policy works. Cobra. I don't know if this is not G.I. Joe. COB is important when a patient has two health insurance. It's who pays first. Good, Paulina. Thank you for that. So uh, that's really good information. So, and it just shows how weak I am in health. Um, so does this have to do with the birthday rule as well, Paulina, when it comes to who pays first? 'Cause that's another thing that comes into play. Yes. See? Ugh, ugh. Um, I should literally let you talk. Um, 5 COB rules. All right, let's do this. 5 COB rules. Insurance. This is how this works. This is how we do things. We do things on the fly. Look at this. All right. And I did know this 3 years ago, by the way, but we usually don't have live sessions with so many health people in here. So we usually keep it on a life slant. So I don't get into a lot of this stuff. But the 5 COB rule, but I do send out, uh, health stuff that I'm sure this stuff is in. Non-duplicating clause rule, the primary plan pays first and the secondary plan pays the remaining balance. The employee versus dependent rule, if you are covered as an employee, the plan is primary. If covered as a dependent, the plan is secondary. The birthday rule, the plan of the parent whose birthday comes first in the calendar year is primary. The plan of the parent whose birthday is later is secondary. Oh, and then it gets really like complicated if their birthday's like on the same day. I'm not even going to talk about it because it gives me a freaking headache. And then the active versus the retired rule. If you are active, your plan is primary. And then if you're retired, your plan is secondary. And COBRA, which is the acronym that we were on, if you have COBRA coverage, the plan is primary. If not, the primary plan is used. These rules help to ensure that claims are processed correctly and benefits are not overpaid. So I definitely think that this would come into play if you're doing like medical billing and coding and stuff like that. So good info. Good info. COBRA, the Consolidated Omnibus Budget Reconciliation Act. Aren't you glad that these tests are multiple choice and you don't have to sit there and write out Consolidated Omnibus Budget Reconciliation Act? So if you have any experience with COBRA, it's basically about continuation of benefits. The COB could say that continuation of benefits basically is offered when you leave an employer, like Starlene says. It can allows you to continue your health benefits for a certain period of time. I think it's usually 18 months, depending on the circumstances of leaving that employer. Hi, Christy. No problem. There's no late. This just goes for 6 hours and you can leave and come as you will. I think, Christy, you've been here before, if I'm not mistaken. And COBRA is super. Oh, you haven't? Oh, first timer, Christy. Sorry. That's a kind of a common name, Christy Smith. I have another story about a Christy Smith, but I'm not going to tell it. It's not appropriate. Deontay's back. I didn't even know you're gone. Sorry, bud. So, but COBRA, if you know anything about COBRA, is super expensive. It is like, because one thing about COBRA, when you pay your benefits, so before you're on an employer sponsored plan, you leave a company and you get COBRA in the mail, like it'll tell you you can continue your benefits. Then you find out really how much your benefits cost. And as a little extra in the chat, yeah, it's not, you're not group anymore. You're paying it on your own. What percentage of the benefits do you pay when you go on COBRA? Can anybody put that in the webinar chat? Nope. Yep. Paulina nailed it. 102%. So not only are you paying 100% of your own benefits, you're paying 2% extra. And the reason you're paying 2% extra is because now you are paying them on your own. And and this also, that could be asked on a test, by the way. You're paying them on your own, and you're paying the administrative cost. Yeah, admin fee. See, dang on it, Paulina, me and you. Um, and then the Starlene, it's been a decade. Hey, you're allowed to forget something in a decade. If you knew everything about Cobra, then you should be working for the government, right? HIPAA. Here's a good one. So HIPAA basically is used for one particular purpose, but when you see what it stands for, it doesn't really kind of bear that out. Kind of the same as Cobra, to be honest. The Health Insurance Portability and Accountability Act. But what we know that HIPAA is generally used for is medical privacy, right? So patient privacy. There you go, Christy. But for the acronym part, if you need to know what it is, and a lot of times how this question is asked is it'll say, what does HIPAA stand for? And this will be one of the answers. So it'll be a bunch of different things, the Hippopotamus Income Protection Act or something like that. And a lot of times they are really stupid. So you go by the process of elimination. But the real answer is the Health Insurance Portability and Accountability Act. And how do I help you remember that other than telling you got to study it? There's not much I can do to help you. That's why we use flashcards, right? UL, Universal Life. So universal life insurance basically is flexible life insurance where you have the ability to change your premium and your death benefit. We'll get into that in more detail here in a few minutes. I said 5:30. I'm on flashcard 20. I think I'm going to nail it. Even getting on rabbit trails and even telling stories, I think I'm going to nail it. So UL, Universal Life Insurance Policy. And if you came late, these flashcards are new for me. So I always try to keep these new and fresh and relevant. So that's why I don't always know what these acronyms are, because these are new flashcards that I had made. And so I may be seeing it for the first time as well. But I do know what this one is. This is a life insurance, VUL, Variable Universal Life Insurance. So, oh wait, I didn't. No. Variable Universal Life Insurance. So it combines the flexibility of universal life insurance and the investment options of variable life insurance. So we'll get further into that when I steer over into the main content. These are just flashcards. This is just something I'm trotting out to again keep things fresh. Just like with marriage, you always want to keep things fresh, do different things. WL, whole life. Okay, whole life insurance, also known as permanent life insurance. It's life insurance that's permanent that also has a cash value aspect of it. IUL, Indexed Universal Life Insurance. Thank you very much. So I say this often on these. Now that you're sitting here with your phone near me and I'm sitting here talking about all these insurance terms, you're going to start getting basically targeted advertisements as you're scrolling through your social media. And anybody that's been on here before, you can attest to this fact. And one thing that's going to come up a lot is going to be Indexed Universal Life Insurance, or IUL. The more I say IUL, the more ads you're going to get. IUL, IUL, IUL. Now, here's the issue with IUL. And the thing to know about it is, so Indexed Universal Life Insurance, we know that Universal has a flexible death benefit and a flexible premium. You can change it based on performance. And then basically you add indexed, meaning you tie that to a certain type of an index like the Standard & Poor's index. And then your cash value, because this is a whole life policy, can fluctuate. The other thing to know about this is if you want to sell IULs, you have to also get a securities license in order to sell it. So you have to get a Series 6 or a Series 7 securities license. And just know that if you think that this test is hard, Wait till you see the securities test. It is even harder. And I never tried to pass it, but I have started to think about taking it. And I was like, nah, not for me. Not at this point in time in my life. Too old, too much knowledge already in there. I can't push enough out to make it fit. DI, it's just disability insurance. Christy says, thank you. Took my exam 3 days ago. Got a 66 after a week of studying. It's a lot in a criminal week. That's amazing. I'm going to give you a hand clap. Did you do life or life and health? Just out of curiosity, Christy. Both. Okay. That's took me 4 weeks to do life and health to pass it. Now, I only took it once and I passed it the first time, but it took me 4 weeks. So getting a 66 your first time, you'll pass it the second time by easily. So now, Christy, you just showed up. Drop your email address in the chat or the Q&A, either one, and I'll send you study materials after. And in fact, anybody else in here that's new, drop your email address in the chat. I'll send you study materials. And if you will send me your transcripts, I will make you a targeted study guide on the areas that you were weak in, and then that'll help you pass the next time. So you were so close. That's crazy. So that's amazing after a week. Very impressed. Very impressed. So I wouldn't be discouraged about that in any way, shape, or form. So yeah, but that's my company. They the one I was going to go work for, they wanted me to do the same thing. And I just like, I can't. I have 3 kids. I had 2 kids in sports. Don't be mad at yourself. No. Think about, so little caveat here. This is free. So this industry, you can make 6 figures, right? You can make doctor money doing this industry. And in a week, you can become licensed in order to do that in a week. And then think about the beginning of that week and the end of that week, how much more you knew after a week and how much closer you are now to passing the exam than you were the first day you started, how much knowledge that you gained in only a week. So, and the fact, if you pass with a 70 or 100, it doesn't matter. Like, nobody knows what you passed your exam with. So, yeah. And a lot of we have a guy that works with us that, now this is going to make you scared. And he did not use our program because it didn't exist yet. Failed 11 times. 11 times. And he's one of our top agents. So it really doesn't matter. It's a pass fail. You got to pass it. It's just a hurdle in your career. Haley's taking an exam tomorrow, hopefully only one time tomorrow afternoon. All right. Well, Haley, we'll be thinking about you. That's my off. I'm not off tomorrow, but I'm doing other stuff. So everybody send good vibes and prayers to Haley so she passes tomorrow. And again, I will send you some last minute study materials. Hopefully you have you put some time into it. All right, let's go to the next flashcard and get as much of this. STD, it's not what you think. It's not what you think. And Starlene's taking hers Thursday. Awesome. So short-term disability, not what you think. A lot of these acronyms, they're used for other things. Okay. Yes. In Jesus' name, amen. Natasha said a quick prayer and put it out there in the universe. But yeah, we'll all be sending you prayers tomorrow, and then again on Thursday for Liz Darlene. And I definitely, when you guys take your exams, and if you pass, I want to hear from you. If you fall short, I want to hear from you both ways. Today, I got 2 back-to-back messages. I got 1 pass and 1 that fell short by 5 points. I definitely want to hear from you either way, and I will help as much as I possibly can. I'm invested in this. I'm not passe. I'm very involved. I'm always trying to improve what I do. So yeah. So Shamel fell short on Monday. Don't say fail. We don't use the word fail. we fall short, right? And we're gonna take care of it the next time. Yeah, overthought. Okay, you mentioned it, right? You mentioned it, so I got to say it. My testing uh, procedure, or the way that I do it, it's not. I'm not telling you to do this. I'm just telling you this is how I do it. Okay, so um, I know you can have paper and you can write things down. You can move backwards and forwards through the exam, but I don't do it. Um, I, and again, I'm not telling you all to do this. There's a couple reasons why I'm uniquely suited to be able to do it my way. Um, I, um, I'm a speed reader. I can read super fast. It's very hard for me to read for leisure because I tend to read really fast. And I have super, yeah. Well, if you're a speed reader, you're a skimmer. So, and you can't really do that with this. It doesn't work. You got to slow yourself down. So, um, but I have high, like super high retention or whatever. So when I took my ACTs. I don't know if you know there's SATs and there's ACTs, and I don't know if you guys are familiar with that, if you've ever taken them before, but I took my ACTs. A perfect score in an ACT is a 35, and I'm pretty sure that's right, 35. I took it 30 years ago, so I got a 26, and I was so bad in math that I like honestly, it was almost so bad I shouldn't have even like answered anything. Like I think I would have done better if I just would have answered nothing in math. It was right out of high school. I wasn't ever really that good in math, but English and reading comprehension, I was like really good in. So I was in the top 100 to 1% on the ACT and reading comprehension. So again, I'm saying all that to say this. I'm not trying to brag on myself. I have plenty of flaws in other areas, but when I took my life exam, I went through it. Now you definitely read the question, okay, and understand the question and understand the answers and answer accordingly. Use the process of elimination, narrow it down. But it took me 45 minutes to take the accident, life, and health. And at the end, I did not go back. I took no notes during the exam. I trusted my gut and I got an 87. So, yes, the wording, watch the wording. Christy, good. Yeah, we talked about that earlier. You kind of showed up a little bit late, but yeah, the wording is important. Annuities got you. Well, that's one of my favorite things to teach. So let me get into that. Let me get done with these dumb flashcards and I'll get into the content. And again, I'm feeling great. So I don't really need to take a break. I'll probably take a break at 7, but I'm feeling good. Yeah. So everybody's tests are different, by the way, Shamel. Like Illinois chops it up into little pieces. It's really weird. You take it like at 2 separate times. Mine was accident, life, and health. I took all at one time. It was 2 hours timed, 150 questions. So it's that's why in this class, because there's 36 people in here, you could literally be from 36 different states. So we do a broad overview of general. Now, I personally feel like if you get a strong grasp of general terms, you can have a medium grasp of state specific stuff and still pass your exam. Now, again, I'm not telling you to do that, but I'm also telling you that I don't second guess myself, because in life and in test taking, second guessing myself always derails me. So yeah, I do too. I don't know if you can tell, but I definitely have the ADHD as well. So that's why I'm always fiddling with something. I have a Sharpie in my hand and I'm trying not to drop it on my laptop to shut this down. I have a I have a tape measure sitting here because sometimes I'll sit here and I'll open and close the tape measure because I have to sit here for 6 hours. And on Saturday, I sit here for 8 hours. And so, I try to make it not so obvious that I'm fiddling with something the entire time. You'll notice now. But yeah, so STD, sure, we'll get through these flashcards so I can get into the next section here. Short-term disability, not sexually transmitted disease. So short-term disability, basically an insurance that you can provide for people that covers for short-term disabilities. It's basically one of the types of disabilities. LTD, obviously long-term disability, another type of insurance that you can provide for someone that covers for a longer period of time, possibly even permanent disability. These can also be riders on insurance policies, which we'll go over when we get to the rider section. SSDI is Social Security Disability Income or Insurance. Social Security Disability Insurance. SSDI. It's what and the question literally could be asked: what does SSDI stand for? And then LTC, long-term care insurance. Also, you'd have a long-term care rider on a life insurance policy. I got a little too long-winded. We're at 5:30, and I didn't make it out of these slides yet. But I'm on these what are these called? Flashcards. Almost out. MIB, Medical Information Bureau, used in life insurance for underwriters to review medical information and cross-check it with the application to make sure everything's on the up and up. APS, don't know what that one is. Oh, yeah, I do. Attending physician statement. So it's something that an underwriter will ask for. Let's say, on the application, it says the person doesn't have diabetes, but the underwriter isn't too sure. Something is basically spooking them about the application. So they ask for an attending physician statement to reinforce the fact that the client or the potential insured does not have diabetes. APS, attending physician statement. And then the last one is ERISA. I do know what this is, but I'm going to flip it over. Employee Retirement Income Security Act. Basically, the laws governing retirement income by the government is the Employment Retirement Income Security Act that governs retirement plans to make sure they jibe with government regulations. All right, so we're going to get out of these. I'll either redo those or throw them in the garbage. I'm not a big fan of that. But get back into my regular stuff. Now I may skip some things because we kind of already went over them. All right, let's see here. Yeah, these general terms we're going to skip over because I already kind of went over general terms. I know some people have showed up later, but I'm going to start here. Also going to check my phone real quick because I got a message. Last time I can't remember what day. Just overheated up. Bummer. Well, I figured that's what's going to happen. So, hold on just a moment. I'm going to message my wife real quick. Sorry, her car's overheating. A jug of antifreeze in the bed. Sorry, still on my live session. To you know. All right. All righty. So life still happens while these live sessions occur. So I gotta handle them as they come. All right. So we're getting back into life stuff here. So what we're going to cover here is traditional whole life products, interest and market sensitive products, term life insurance, annuities, and then combination plans. So we'll get right into this. So ordinary whole life. I'm going to check the poll real quick, see what we got in here. Yeah, we're about 50-50 life only. We have one health only person. Oh boy. Yeah. I don't know if you're still here, health only person. The next little bit. It's not going to be for you. But when we get into the live questions at the end, about the last hour, hour and a half, they will be a mix. Fernando says I'll be leaving a bit for a doctor's appointment. We'll be going into my trainings. All right, cool. Absolutely. Thanks for being here, Fernando. And again, I'll be back on Thursday. So I'm like a lounge singer. I'm here every Thursday. So same link on Thursday. Same time, 3 to 9. I need to wear like a leisure suit or something. So anyway, that's only gonna make sense to certain people, but all right. So we're into Fernando gets it. Fernando gets it. One of my best friends named Fernando also. So that's very interesting. So yeah, he's an interesting guy. I could tell some stories about him, but he would be so mad at me if I did. I'm not going to, but he'd be mad. All right. So ordinary whole life. So I'm gonna get my pen out, which I haven't been able to do yet, which has absolutely been killing me. Those flashcards, they do everything for you. So ordinary whole life. Whole life, also known as permanent life insurance. Basically because it's not term insurance. It's good for your life, which your life basically goes to 100 years old or 105 years old, depending on the policy. But basically your whole life. Why it's called whole life. Coverage for your entire lifetime. So you have a death benefit to a whole life policy. We're going to say 100,000. I'm real shaky right now. It's not helping me with my pen. So this is your death benefit. And then level premiums through life. We're just going to use $100. And then these also have a cash value. All right. And that's over and above the death benefit, right? So these accumulate cash value. Now, this money goes into a general account of the insurance company. Lakeisha says, I'm going to step away to vote. I'm going to be talking about the same thing on Thursday. It's going to look a little different on Thursday. I'll probably, I don't know, do something a little different because I didn't really like those flashcards much, but I think they might have been a little bit helpful. But if I see you on Thursday, be awesome. And I'll try to keep it fresh. Thank you for doing your civic duty and voting. Here's me saluting you. All right. So these, when you pay into a whole life policy or when your client pays into a whole life policy, their cash value goes into a general account that typically grows. We'll be here till 9 p.m. Eastern Standard Time. And it grows at a basic rate. So with a basic life insurance license, you can sell ordinary whole life. You can sell limited pay. You can sell single premium with just a regular insurance life or insurance life license. All right. So these are generally like just a basic savings account at a bank or something like that. So level premiums throughout the life, guaranteed cash value accumulation, and then they have a fixed death benefit. So after about like 10 years or so, the cash value on this policy might be like $12,000. And then you have access to this. You can take loans on this. You can take hardship withdrawals, distributions on the cash value. But the death benefit remains the same. But let's say you didn't touch this cash value and you pay into it for 10 or 15 years or something like this, and you pass away. To your beneficiary in this scenario, the death benefit would be $112,000. So that would be what would go to your beneficiary is $112,000. Now, if you have loans on it, they'll reduce the death benefit by the amounts of the loans or the interest that's due on it. Really doesn't matter, but just for your edification, that's what happens. Then you have limited pay. Okay, so basically you have premiums that are paid over a specific period. You can do this a couple different ways. You could do 20 monthly payments, and then you would have a fully paid up. I didn't mean to cross that out. You'd have a fully paid up policy, and I don't like this color. I need something flashy here. Let's do hot pink. So, so after like 20 payments, then you would have a paid up whole life policy. Now, these payments might be much, much bigger. Now, these could be like quarterly payments. You could say, I want to do 20 payments over, like a 10-year period or anything like that. Doesn't really matter. But for simplicity's sake, let's just say you're doing, what is the $100 for? That was the premium on a whole life policy. So when I was up here, I did the death benefit. It was like not pink, so that's why it didn't really stick. So 100,000 is your death benefit. $100 a month is your premium. So this is your death benefit. $100 a month is your premium, and then on a whole life policy, it has a cash value that is above the death benefit. So another thing that I kind of didn't bring up, that's neither here nor there, but so part of this premium goes towards paying for the death benefit. Let's just use $20, all right? It's just an example. It's not foolproof, but that means $80 of this 100 is going towards building the cash value. So basically $80 a month on a level premium whole life policy is building the cash value. That's why after about 10 years, you should, with the growth of the money in the insurance company's general account, you would have like $10,000 or $12,000 as a cash value if you pay on a whole life policy for about 10 years. So that's your level premium, but part of it goes towards funding the death benefit. Part of it goes in for like a small savings account. Again, it's not a retirement plan, but for somebody that's not a good saver, it's a good plan for someone to have a death benefit and to have a little bit of savings to fall back on that you can tap if you need to. And then limited pay. Now, let's keep in mind, let's say someone's like 40 years old, right? And they're getting this whole life policy and the premium's $100 a month. Well, if they're going to cut that to 20 payments, this payment could be $1,500. Now, it's probably not $1,500 a month. Maybe it's quarterly. But after all these premiums are paid, and again, this is a premium, $1,500 for a 20 pay life. This is not going to be something common. You're not going to get one of these a week. You're probably not going to get one of these a month. You're going to get one of these every once in a while. And someone that's doing a limited pay. And, again, 20 payments, $1,500 per payment. And then the death benefit is set. It's like let's say on this case right here, the death benefit is $150,000, right? Well, if you do this 20 pay, again, like $30,000 total in premiums that you pay over the 20 pay, then this $150,000 goes in a lockbox. Trying to make a little keyhole here. So it's a lockbox. It's guaranteed. And then also, you've paid $30,000 into it. You have at least $30,000, or not 30,000. You probably start out with like maybe $25,000 or so in cash value. So your cash value accumulates quicker. So it's not like they're just paying you $30,000 and it's going for nothing, essentially, only something when they die. They're going to have immediate cash value on that because the other is a single premium. Now, overall, these payments are going to be less than they would have been if this person paid $100 a month for 30 years. Obviously, that's going to be like $40,000 or so. So now, again, I'm just using general figures here. Don't hold me to any of this. But if you pay something in a shorter period of time, it's going to be less. There's going to be a discount to that because there's less administrative costs for the company. And then lump sum, you might be able to get a $150,000 lump sum insurance policy, and it might only cost you $25,000. Now you say only, that sounds like a lot of money to me. It is a lot of money to me. It's a lot of money to anybody, but to the person buying this policy, it might not be a lot of money. And there may be a reason that they want to do it. But just know, if you do unlimited pay or single premium, they're paid up policies. And then they have higher cash values to accumulate faster. For testing purposes, that's what you need to know. All the rest of that information is just to help you understand what it's all about. Now, we just went over basic whole life. Now we're going to go over interest and market sensitive products. Okay. So these, you have to have the securities license issued by FINRA, FINRA, in order to sell these products, right? So you have the first one is universal life. And we kind of, if you've been here the whole time, we went over these with the flashcards. So you might be seeing this for the second time now if you're new, or if you've been studying this for a little bit, we're going to reinforce your knowledge. So universal life, the main point of universal life is they have flexible premiums and death benefits, and that they have interest sensitive cash value. So they're tied to some interest rate of some sort. Generally on these, it's something like a treasury bill, a T-bill, or maybe like what's called the LIBOR, some sort of a, interest rate that these are tied to. And then transparency and charges and credits really probably isn't going to be anything that's ever tested on, but it does help you determine what you want to put in for premiums and whatever you want to change your benefit, because you can change these based on the market performance. But that's universal life. So the next one is variable whole life. So I'm going to draw some buckets here, and there's a reason for my buckets. Okay. Hopefully these help you. Variable life. So we have various buckets here, or multiple buckets, or separate buckets. Okay. It's cash value invested in separate accounts. Now let's go back to our basic whole life account here, because these are all whole life products. That's kind of important. So these have premiums, these have cash value that's over and above the death benefit. Now, when you're investing out of these accounts, so variable whole life, now this could be called universal whole life. These are all whole life policies. They're permanent. They don't make any sense for term. And we'll get to term and you'll understand why they don't make sense for term. So variable whole life, your cash value, which is over and above your 100,000, you pay into this for 10 years, whatever, a little different because this is more of an investment type account. So let's say you have $15,000 cash value in this. Somehow you got that. Well, because you've invested your cash value into different accounts. So your cash value has been invested in different accounts. Now, all the risk goes to you or your client because they're choosing where this goes. These can be very aggressive. These can grow much quicker than this one because this is just going to be based on some flat rate, type of account. These might have 1 to 3%, growth. Now these might have 8 to 10% growth. These could grow much quicker. So this cash value is going to go up faster. Also know, again, all of these require this, a securities license to sell. Anytime you have the ability to lose money with your cash value, you have to have a securities license in order to sell it. Now, you're not investing this. This is your death benefit, right? You're not investing that. You're only investing the cash value, the money that is yours for these. So we did universal, flexible premiums and death benefit. We did variable, separate accounts. And then you have the combination, variable universal life, which is the flexibility of universal premiums and death benefit and the investment options of variable. So it has all kinds of flexibility, but also the greatest risk because you're choosing the accounts. So these are interest sensitive products. Okay. So these are all interest sensitive. I'm sorry. If you're not investing, because these are not typically interest, universal would be interest sensitive. These are different because these are based on how these accounts perform. So these might be like mutual funds, right? These different accounts, kind of like a 401k, how you put your money in separate accounts in a 401k that grow. These are the performance is directly linked to how these investments are performing. All right. So interest sensitive would be universal, and then not like are these. Then something totally different, and we're going to clear everything from here, is your indexed returns, or we saw our IULs. You can have indexed universal life. So you have returns linked to market index with downside protection. So, but indexed is the term we want to look at right here. So what these do that's unique is you have a floor, and we're going to use 3%. I usually use 4%, but that's super aggressive. It's not happening. So they guarantee a return of 3%. And these are going to be tied to an index. I did a 3. I meant to do an S. Like the S&P, Standard and Poor's. So they'll be linked to that. And again, it's your cash value. Shoot. Did I lose my pen? Hey, give me my pen back. Cash value. Oh my word. What in the world is that? Get rid of that. Don't clear it all. Just get rid of that. That is awful. Get rid of all that. Get my pen back. I just need a V. And your cash value gets invested in this. And then it's gonna do this, right? It's gonna go up and down, just like the market, because it's gonna be based on the whole performance of the market. And it could do this. But the insurance company is guaranteeing you a minimum. But then what also could happen is it could go up here. And that's what they're wanting to happen. They're wanting it to go above this, which would be like 8%. That's a cap that they put. And it's basically how these indexed ones work, right? Now, what happens with this money? Someone asked on a previous live, how do insurance companies make money? Oh, they make money. And this is one of the ways. So with these index life policies, you're going to gain money on your cash value. And then if you make a lot of money, like you get into the 12 and 15% returns, sometimes 20 and 30%. It's not unheard of for it to go up that high. The insurance company keeps all of it. And the whole reason they do it is because they provide this downside protection. So indexed, returns linked to market index, S&P is just an example, with downside protection. That's how an indexed life policy works. Now, if you can't even sell any of these unless you have a securities license, but they will be tested on in your basic life test. The next section is term life. And basically what we're going to do here is there's a practice exam at the end of these slides, or not the end, but like I think slide 13. I'll take a break once we do this first practice exam, just a 15-minute break or so. And then we'll come back and we'll see where we're at with that. We might get into some live test questions at that time. Again, it's about 6 o'clock. This is over at 9. So at least by 7:30, I would say I would want to be getting into the live questions for the last like hour and a half or so. Yeah, right. 7:30 to 9. Yeah, this ends at 9 o'clock. So, but we talked about whole life. We talked about universal life and index life. Now we're going to talk about term. Term is your basic milk toast. Everybody sells it. And then most people have it. Term life insurance policy. So you have a level term. So we'll get out the pen again. So level term, $100,000 we're going to use again. Now they're cheaper, right? We're going to say $35 a month. We got someone in average health, $35 a month. That is your premium. And then the difference between whole life and term life is this will also have a term. So 10-year, right? Could be 10 year, 20 year, 30 year. Could be 5 year. Can be 1 year. Doesn't matter. This is the term, 10 year, just using that as an example. So if someone passes away within this 10 years of this policy, then the death benefit is $100,000 to the beneficiary or beneficiaries. The one thing to know about life insurance is it creates an estate. Annuities manage an estate or provide income from an estate. The difference between life insurance and annuities basically is annuities pay out of an estate. Life insurance creates an estate basically out of nothing. So when you die, whoever the insured dies, then what's left to the beneficiaries is the estate. All right. So in this case, level term, 100,000, 35 bucks a month, 10 year. If the person dies within the 10 years, the 100,000 is paid to the beneficiary or the beneficiaries. Now, here's the shocking part. Okay. And again, this also answers the question, how does an insurance company make money? By selling term life insurance. Level term life insurance policies and annually renewable term life insurance policies, the percentage of those policies that pay out is shockingly low. Generally, I will ask a question if I have a class with only 4 or 5 people in it. Doesn't really happen that much anymore. When I first started out, though, I would have 4 or 5 people in my classes. And the question I would ask, what percentage of level term, and annually renewable term life insurance policies pay out a death benefit on? And I'll get answers of like 15 years, 20 years, or 20, not 15%, 20%. I've had people guess as much as 80%, which is not even close. None of those are close. Crystal answers. You've been here before. I know you've been here before. 0%. Yeah, it's like 0 to 2% of them actually pay out. So there's millions of them, and there's millions of people paying for them. They're basically just padding the accounts of the insurance companies, and that's how the insurance companies are making money, because they're taking that money just like your bank does, and they're investing that money. So another answer is how insurance companies make money is selling term life insurance. And LaQuisha says, good afternoon, I'm in Las Vegas. My text we was starting at 3. This is 3 Eastern Standard Time. So these lives are recorded. I'm recording, so I can send you first of all, put your email address in the chat or in the Q&A, and I'll send you out some study materials once the live session is over. But yeah, it's 3 p.m. Eastern Standard Time because I'm in Ohio. So we go 3 to 9 Eastern Standard Time. And I will send you out basically a PDF with life materials and a PDF with health materials separate. And then I send out a link to a video that Justin produced about creating your own study materials for your state specific stuff. And then also all kinds of stuff. I provide all kinds of stuff. The email is getting ridiculous. And there's a lot of good stuff, a lot of good resources in it. So, but yeah, all these are recorded. I usually send out an 8-hour one that's about split half and half between life and health, that I'm particularly proud of. And then you can get this one as well by request. It just takes a couple days to process in the system. So I used to think they went to your guys' dashboards, but apparently they don't. But you can always email me back. My email to send transcripts. I don't want 50 emails, but I will put my email address here. If you gave me your email address, I will email you after this is over and you can respond to me, but I'm putting that in there. Just please don't overload my email because it's already overloaded and I can't keep track of them all. Monica, you failed life on Friday, but I think it was your test anxiety. How close were you, Monica? How close? You don't have to tell me if you don't want to put it in there. but I think you're in a safe place. So we've had a 6 points. See, that's everybody right now is falling 5 or 6 points shy. So you've got my email address, Monica, I'm sure. So email me your transcripts, and I'm going to be creating a lot of targeted study materials for you guys. So, and I'm happy to do it. I'm happy to do it. Yeah. So, well, Keisha, I will. I go over a lot of the same stuff in all of my live sessions. So, my 8 hour one is very comprehensive. So I'll send you an 8 hour one, and then by request, I can send you a specific session if you want. And then some of my sessions get chopped up, and I lose some of it, and all that kind of stuff. So I don't like to send those out because they're clunky. But all my lives are pretty similar. But I'll definitely include a live link in the one that I send out in the email, and then all kinds of stuff. So, and Monica says it's her fourth live. Boy, she's really a glutton for punishment and learned something new in each one. Good. I appreciate that. So I know you've probably heard all the stuff I'm getting ready to say. But again, I try to do change. And then I'm not sure if you've been in one where I do the live test questions at the end, but that's what I'm doing in every one now, where I go actual ones that you'll see on the where you have been in one of those. Okay. Yeah. So that's what I'm doing at the end of every one of them now, but you'll see all new questions because they all randomized. So you'll see new questions. So we kind of went over this because I did some flashcards in the beginning of this one. So we did some general terms on the flashcards. I didn't really like those very much, so I may not do those again, but I'm trying to mix it up. But decreasing term is something we already talked about a little bit, but I'll go over it again here. Also called mortgage protection, where I use my example where you have like a mortgage and whoa, I don't know. That was supposed to be an R. I'll cross my T. So let's say 300,000 mortgage and a 20-year mortgage. And as you pay on your mortgage, the balance of it goes down, usually really gradually at first, and then it starts to drop off a lot. Well, you get a decreasing term, which is actually the death benefit reduces over time. So it will follow your amortization schedule and it'll go down as well. Now, I think mortgage protection, life insurance is a bit of a gimmick. I'm not a huge fan of it. It has its place, but in my opinion, all it should be is a foot in the door. Like, a lot of you guys that are in here that are doing life insurance, a lot of new people sell mortgage protection insurance. And I think your agencies would agree with me that it should not be your end goal to end a call with a client with mortgage protection and that be the only thing that they buy. Because, again, it does pay to the beneficiaries. The beneficiary of a mortgage protection insurance account, unlike credit life, in credit life, the beneficiary is the Adam. This is general, so I'm not covering a module. This is all general because again, I don't know what state you're in, and generally modules will combine like state and general stuff. So yeah, this is all general, but 80% of your tests are generally. Like I just did a targeted for one state, and state specific stuff was 18%. So yeah, I'm not in a specific module. This is just a general study group, and we're in life insurance right now. And I just go over like, now, I mean, it's kind of module driven where right now I'm talking about life or, types of life insurance. So, Junior and everybody that's joining late, change your drop down in your chat from host and panelists to everyone, and you should be able to see the chat. But I will email you is really what I want to happen. I don't want to get 100 emails. But I did put it in the chat, and I will put it in one more time. I won't do it again because, again, I will email you, and then you can respond to me. I just don't like getting a million emails. So yeah, but if you're just requesting transcripts and whatnot, you can email me. If you've previously taken the test and fallen short, I don't say fail. We don't use the word fail. You just fell short. You'll get it the next time, and I will help. I will help with that in any way, shape, or form I can. But yeah, not module based. We're just going through general stuff. So we were going over decreasing term, and again, I was saying I kind of think that it's more of a gimmick than anything. I'm a foot in the door. You still have beneficiaries. It's cheaper than general term life insurance, and that's why a lot of people do it for new agents, because the premium does not change, even though the death benefit goes down. So it's a little cheaper in the beginning. Also, generally, if a mortgage, you have a younger clientele with decreasing term. So they're generally younger, they're generally healthy, they may be young married, starting out life. But if if you provide somebody a mortgage protection life insurance, you should also probably be doing either like a small whole life policy to go with that. That would have a, burial policy, or maybe a medium range term life insurance policy for 10 or 20 years as well. Or the next term, return of premium. My favorite policy is return of premium. And if you've been here before, you've heard this story ad nauseum, but my mom had a return of premium policy. This was my first exposure to a return of premium policy. When she was 60 years old, she remarried her third husband, and they built a home together. They each sold their home, and they built a home together to retire in. And it had a pond, and it had a bridge, and it had land. And they were going to ride out their twilight years in that home. Well, her insurance agent called her and said, hey, you've got a new mortgage now. I don't know how he knew. I have no idea. He probably just called her randomly, and they were talking about it. And he found out about it, and he said, you need a small, life insurance policy to, if you pass away, they can pay off that debt for your son. It was me. I was the only, well, he had kids as well. So I guess for everybody. And so she got that policy. She was 60. It was a 20-year return of premium policy. Now, I don't think she fully understood what she was getting when she got it, but for her purposes, it was a great policy to get. Her insurance agent did a great job. That's how I learned how good of an agent was. And it also is kind of what led me into the business, because when she turned 80 years old, she paid into that policy for 20 years. It had a $50,000 death benefit. The premiums were like $120 a month, something in that range. And she was on a fixed income. So it just kind of came out of her bank every single month, out of her Social Security check. And she didn't really think about it. Well, she turned 80 years old. She lived out the term of that policy. The agent called her and said, hey, where should I send your check? And she's like, I don't know what you're talking about. He said, you got a return of premium policy when you turn 60. And now we return all your premiums to you. So do the math, 20 years, $120 a month over 20 years. It was over $20,000 she got back. And my mom was a terrible saver. So it was a blessing, absolute blessing, to get that money back. Now, you might be thinking, as a new agent, as a new licensee, why in the world would an insurance company want to do that? Well, I'll tell you why. So she's 80 now, right? She's close to death. They got those premiums for 20 years. She paid them every premium on time, no problem. The insurance company was able to invest that money, and her death benefit was $50,000. They would rather give her $20,000 back than pay out a $50,000 death benefit. So she wrote out the term, they repaid it, and then guess what? The agent was able to sell her an end of life policy. Now, I don't like to use the word sell, but in this case, it works. You're going to want to shy away from that word when you're doing this business. You don't want to say sell. You want to say, coordinate, provide, whatever you want to use. But when you say sell, you automatically, the walls go up. You want to not introduce those walls. And she got a funeral policy or a burial policy, $8,000 death benefit, $100 a month. And so it was a little bit cheaper, but obviously a much less death benefit, but she was a higher risk because she was 80 years old and she had high blood pressure and a couple of other minor ailments. And he got to sell another policy. He got to make another commission. She was happy. She got $20,000. And again, the policy premium went down a little bit, but $100 a month for an $8,000 policy. Guess what? She lived 8 years longer. She passed away when she was 88 years old, and she paid $100 premium for 8 years. Guess what? She fully funded her life insurance policy at that time. So the insurance company basically lost nothing, and they got to rent her $20,000 for a 20-year period. So, and the agent got to make 2 commissions off of her before she passed away. Great agent, great product. I love return of premium. So I like teaching it because of that story. And, again, it's partially, what got me into the business. Then you have annually renewable. As much as I love return of premium, I hate annually renewable. It's stupid. But it has a point, it has a purpose, and basically it's for employer provided life insurance. So you get your benefits every year and you renew your benefits in October or whatever of every year. And usually you're given an annually renewable life insurance policy equal to your 1 year salary or something like that. So that's where these are. Now, if you're an agent and you're selling annually renewable term policies, you are not doing your clients any favors. Now, they can renew them annually without a medical exam, without proof of insurability or new underwriting. But do you really want to deal with that every year as a person and having to renew your life insurance? That's really dumb. So don't do that to your clients. Now, it says renews each year with an increasing premium. That's probably true for an independent annually renewable plan, but it's probably not true for a group annually renewable plan because I'm sure they have deals with the insurance companies where those premiums don't go up. But annually renewable term life means every year they renew. Pretty easy. Then special feature. Okay. So the way I explain these are like a pizza. So if you go to order a pizza and you're using the app and you see what's the ones that are listed as specialty pizzas, you have your Hawaiian, your meat lovers, your veggie lovers. Well, these are special feature term life insurance policies. So with these, level term is going to be your average cost insurance. Decreasing term are going to be a little bit cheaper than a level term. Return of premium is going to be a little bit higher than both of these. And annually renewable will probably be about the same as like a mortgage protection starting out, and then they'll go up every year. Now, special features, these will be like a specialty pizza. If you go to get a Hawaiian or meat lovers or whatever, they're more expensive than like a build your own pizza with just adding the toppings how you want. But they have features that are good to provide. Renewable. So basically you get, let's say, a 5-year renewable term life insurance policy. So after 5 years, they can renew the same exact policy without evidence of insurability. And everything's basically the same, but the premium will go up. Then you have a convertible, which is another one. So you want to see my 2 favorites, return a premium or convertible. You can exchange a term life policy for a whole life policy without a medical exam. So you can change that $100,000 term life policy after 10 years, change it into a whole life policy, no underwriting, no medical exam. Now, just know that the premium is going to go up because, again, your policy is going to go from being an expiring term policy to a whole life policy that builds cash value. Now, these are good things for you to provide your clients because, again, it's going to help you keep in touch with them, see what's going on in their life. You're going to make more commissions and you're going to be doing right by your clients as well. If you just are aiming to sell somebody one level term policy and never speak to them again, turn and burn, you're not in this for the right reasons. So you want to be someone's lifelong agent. You want someone to say, man, I just had a great experience with I'll just pick Junior at such and such life insurance company, and he did a great job. He really listened to me and offered me things that was important to me, and you should use them. And people do that. People love referring people. Something will trigger them. They'll hear it. Maybe someone says, oh, my family member passed away. I just went to a funeral, and then they're going to remember, hey, I just got life insurance. And it's probably not going to look like a commercial and be like, I hear you, and you're really going to want to use this company, and I just talked to this agent. But they might say, if you were in the market for life insurance, or if someone brings that up, you're going to want to talk to my guy. People love making referrals. Annuities. Someone asked earlier to talk about annuities. We're going to talk about annuities. And so the best way that I can explain talking about annuities is using the lottery. All right. So, and there's a couple reasons that I do that. LaQuisha says, my son is disabled. I spoke to several insurance agents and they said he couldn't be covered. I just would have to save up. So I'm asking if he can be covered without a medical examination. So there are certain companies that also, depending on how old your son is, there's some insurance companies that handle things like that through rating where they don't do any medical. You'd have to do I would do a web search, kind of an aggregator. Okay. Yeah. I would use, it's weird because with insurance, with life insurance, it's much easier to get life insurance after someone turns 50. I think it's because you kind of go into a protected class. But what I would do is I would get into, say, a group, a chat. My wife is in a group of other autistic parents of autistic children, and she gets a lot of her information that way. So I would get into a group of people that deal with kids with disabilities or adults with disabilities, and then see what they've done, because you probably could get into become a member of a fraternal insurance group, or not insurance group, but a fraternal group that you can get group benefits through by becoming a group member. But yeah, that's what I would do. Get into a forum or a group, maybe on Facebook, and ask them, and then they would be able to direct you instead of you just kind of flying blind and doing searches like that. And then that way you can find out, more specific recommendations of people. And then we'll learn about, well, we won't today because I won't get to that part in the topics, but there are groups that you can become a part of, and you can get group insurance, which is so much easier to get because you're part of a larger group, where you don't have any underwriting, and basically it's approved as part of the group. So there may be a situation out there like that. When you get older, again, you have AARP, you have things like AAA. When you become a member of AAA, you're becoming a group, and you'll get advertisements for life insurance through AAA, AARP. Credit unions generally will offer group life insurance plans that you can more easily qualify for. Usually they do have some underwriting, but hopefully that helps you out there. But back to annuities. So my lottery example, I think right now, I believe it's Mega Millions. I think it's like $800 million, meaning there hasn't been a winner for several weeks. And once it gets up to a larger amount, then generally it starts to make the news, and the news starts talking about it. And one of the first questions that's generally asked is, what is the lump sum? Like if you took a lump sum on 800 million, maybe it's like 200 million or $300 million or something if you took it in one lump sum. Then the next question would be is, how much is it after taxes? So maybe an $800 million lottery, maybe it's like $180 million after taxes. I think I could probably scrape by on that if I really tried hard. But if there's another way to take the payments, and usually doesn't necessarily even get talked about, but you can take it in annual withdrawals every year for life, right? And on an 800 million, maybe the payment you get maybe $15 million for the rest of your life. $15 million a year, still a lot of money, but most people don't do it. But how those are paid out, they're paid out of an annuity. So the lottery commissions fund the annuity with a single premium, and then the payments pay out to the winners over their lifetime. Now, the people that would do that, they think that they're going to live longer than they would if they just took a lump sum. But the other way to look at it is, if you do win the lottery and you take a lump sum, the best thing for you to do with that money is to do a single premium, one lump sum payment annuity. Look at it and treat it like income. Okay. So there are so many stories, and there's TV shows that are dedicated to people that crashed and burned based on winning the lottery. They win tons of millions of dollars in the lottery, and they blow through it in 3 or 4 years. And you think, well, how on God's green earth is that possible? And you think about in your life how you scrape by on very little or paycheck to paycheck, but you're still making it. And these people go from, that to having millions of dollars to back to having nothing. Well, it's pretty easy. Same with like sports stars and celebrities. The riches to rags stories where, they buy their family members houses and cars, and they pay debts off for their family members, and they have family members come out of the woodwork they didn't even know about, and they're all with their hand out, right? Well, yeah, you can blow through a lot of money really quickly that way. But if you're smart with it and you fund an annuity, then you treat it like income. So you have all the access to the money, but you treat it like income. So that's like a single premium annuity, right? Is you get maybe a settlement from a lawsuit, or an insurance claim or something like that, and you can do a lump sum single annuity payment, and then you start taking income payments immediately. Okay, which in the world of annuities means within 1 year. Okay, so single premium, one lump sum. So you fund an annuity, we'll just use $1 million or whatever, and then you take an immediate payout, meaning the payouts begin within 1 year. Now, usually it's 1 month, but it can be upwards of 1 year and still be considered an immediate annuity. That's usually paired with a single premium annuity, because you're funding it and then you're taking income payments right away. Then you have a flexible premium, variable payments over time. So we have Billy Joe Jim Bob, and he wants to retire when he's 80, or no, not 80, 60 years old. Who wants to retire when they're 80? So I'm going to retire and I'm going to live 5 years. But so when he's 40, he starts a flexible premium annuity where he funds it over time. There's no set premium. He just puts money in when he can. Maybe he gets profit sharing at his work, and then he throws all that profit sharing in there. Or maybe he gets a bonus and he throws that in there. So over 20 years, he throws money into this annuity. It doesn't have to be on a schedule. It's just variable payments over time. And then he takes deferred payments, meaning when he turns 60 years old, he's going to start taking income off it, a future date. So that's deferred. Immediate, within 1 year. Deferred is in the future, usually on a flexible premium type situation. All right, so investment type, fixed, guaranteed interest rate. You have an annuity company, the money goes into that, either a big lump sum or over time, and then the money just grows. It's generally the annuity's general account. So it's probably like a certificate of deposit. Maybe it grows at 1% or 2%, but it's guaranteed. It's never going to change. It just is what it is, right? Then you have variable, which is just like what we talked about before. Okay. Remember our buckets, right? Variable annuity, variable insurance, same thing. Your money's going into separate buckets. Now, again, if it's flexible, it's going into the buckets over time. You're just slowly filling your buckets. Or one big lump sum, you have a tidal wave going into your buckets on a variable. But just know with a variable annuity, you have to have that extra securities license because there's the potential that they could lose money. So anytime you can lose money, then you have to have that extra license. And then indexed. So indexed is just like we had before, where you have a floor and you have a cap. We're going to use 3%. We're going to use 8% here. And then it's tied to an index like the S&P, and it goes up and down. But you have a cap, and then you have a floor. So they're guaranteeing you this return. But these are a little more aggressive because they're tied to an aggressive market, right? But again, with indexed, variable, you have to have the extra license. Fixed annuity, with your basic life insurance license, you can sell fixed annuities. But if you have anything that could potentially lose, then you have to have extra license. Now, this, I haven't even mentioned my siren yet. Usually I mention my siren by now. But if I had like something on my desk and I'd hit a siren, like that Mad Money guy, that investment guy, I would be hitting my siren right now because this is going to be on your test in some way, shape, or form. I 95.9% guarantee it. So in an annuity, there's two separate periods. You have your accumulation period where the value grows, and then you have the annuity period when you start receiving payments from the annuity. That's what the annuity period is called, also called the payout period. But for testing purposes, we're going to call it the annuity period. And then the accumulation, it's just common sense. It builds cash value, or it accumulates as you're paying into it. Or if you single premium payment, fund it, and you don't start taking payments right away, it's only building. It's not going down at all. But even once you start taking payments from an annuity, whatever's left in there still grows based on whatever kind of investments it's tied to. Oh, and this next is the My Little Practice exam. Oh, crud. Hold on. I got to reset this real fast. We're going to do that, and we're going to get back to this section real fast. Back to where we were. Combination plans and variations. Okay. So these could be variations on other types of whole life or term life policies, or they're just kind of their own thing. But I'll just explain them. You'll understand once I get into explaining it. But I definitely use my pen for these. So joint life. Also, no, what's going on here? Oh, hold on, I gotta get rid of this because I gotta move up. All right, get my pen going. Joint life, first to die. This is how this is tested on, by the way. Joint life, first to die. So this can cover 2 or more lives. So we're going to draw one more life over here. Let's see. Last time I did business partners. This time, I don't know what's going on. This time we're going to make this a husband and a wife and a kid. And then A joint life policy is like an umbrella. It covers all these lives, right? So you have a death benefit. So we're going to just say it's a joint life. We're going to give them a little bit more of a death benefit here. We're going to say 500,000. So the premiums doesn't really matter what they are. Let's say the premiums on this is $150 a month or something like that. But it's cheaper than if you were getting separate policies for each one of these people. Okay. So because it's a blanket type policy, it's a little cheaper than if you got, because you might have a $500,000 same death benefit on all these different people. Each one of them might have $150 premium, right? Now the thing to understand is this pays the death benefit upon the first death. So if it's a husband and a wife, and the other person, whoever this person is, if they pass away, then the death benefit goes to these two. They're not beneficiaries. Okay. The difference between them and beneficiaries is that it pays upon the first death, but there's this much coverage on all of these people. Okay. So if they were beneficiaries, then it would, well, you'll see when we get to survivorship life, it would take at least two of these people dying to go to a beneficiary, or all of these people dying for it to go to a beneficiary. But these people are all covered by this same death benefit. So basically, whoever dies and whoever stays living, they automatically get that death benefit. So this is used commonly for business partners. So if these two were business partners, right, and you had a first to die policy, then if the business partner passed away, the death benefit money went to the other business partner. He could use that to pay the family of this business partner to buy out their portion of the business. And then he could also use that money to, possibly replace that person. There's all different kinds of things, but he's the beneficiary, not the business, because there's something called key person insurance as well that covers the business. This just covers the other partner, or it could be a spouse, or again, it could be a parent and a child. But the main thing to know is that joint life is known as first to die. Okay. And then you have survivorship life. Now, this only covers two lives. So we're going to use a generally husband and a wife. She's got long hair and he's wearing a hat. So it covers these two, right? And these are different because these are going to have a beneficiary or beneficiaries, right? And last time I called him spoiled rotten brat. This time he's gonna be perfect angel. So we're gonna give him a halo. All right. So this kid's a perfect angel. He's awesome. And then we'll just keep him as one. He's the beneficiary of the survivorship life. But for this policy to pay out, these both have to pass away. Now, not at the same time necessarily, but just know if they do pass away at the same time, that's called a common disaster policy, meaning they both died. The death benefit automatically kicks in and it goes to the beneficiary, perfect angel. Now, again, covers two lives, pays upon the death of the second insured, and then lower premiums than individual policies, same as a first to die. But also remember, survivorship life, second to die. So you got those two S's. That'll help you remember the answer, because usually it's how it's asked is what is survivorship life also known as? Second to die. But I'm going to give you a little bit of help to understand what this is all about as well, because it's used for planning and tax purposes, estate planning and tax purposes. So why is survivorship life important? So again, this is about knowing your clients, right? Asking the right questions leading up to the point in time when you're going to start building your policies for them. So survivorship life is going to be someone who's more affluent. They have assets. So we're going to say they have a primary house where they live with their perfect angel son, and they have maybe multiple cars. Again, maybe dad collects cars possibly. And then they've got he's got a 10-car garage, whatever, he's got all these garages, right? And then they got all these cars. Maybe he's got a car collection. I have an insurance agent buddy that has a collection of Mustangs, and he literally has a pole barn and it's full of Mustangs. And he's an insurance agent. He's been an insurance agent for 30 years, 40 years, maybe, long time. And they have a vacation home. So again, that's asking the right questions about these people. And I haven't said it yet, but it's because I've been more focused on terms this time. But I have a little sticky note on my monitor, and it says 3 words. It says, "Tell me about dot dot dot," and I've used that for my entire sales career. Now, you may have a script wherever you're going. Use the script. Do what your mentors or your companies tell you to do. If it's more loosey goosey and you can kind of do your own thing, I use "Tell me about," and it's just getting people talking. People love talking about themselves. Tell me about your house. Tell me about your spouse. Tell me about your job. Tell me about your kids. Tell me about your dog. Tell me about your car. Just get people talking. Telling you about themselves. Become their buddy. And then as you listen, write stuff down as they're telling you about. And then again, you find out your client has a house, and then they have a vacation house. They have a cabin somewhere. They have a car collection, whatever it is. They need a survivorship life plan. If they don't have one, they need one, and they need it. Absolutely, 100% they need it. Because here's something that this all goes with, right? You have affluent people, you have people that have a lot of stuff. It doesn't mean they have $1 million in the bank. They have assets, they have debt that's tied to all this stuff. They have debt. Wealthy people have debt. This idea that millionaires and billionaires, all this kind of stuff, that they have a bunch of money just sitting in the bank. It's not how you judge somebody's wealth. It's usually they have a company and they have stakes in their company, or they have all these assets, or it's real estate or whatever. They don't have $1 million sitting in the bank. They don't have $1 billion sitting in the bank. They have debt. They have assets. That's how they're judged. They're a millionaire, they're a billionaire, but they don't have $1 billion in the bank ever, never, never, ever, never. I'm going to say it across the board, rarely ever. Maybe like recording artists or actors or actresses, because they're just getting paid, right? So they have money, but they don't really necessarily have a brand. Some of them might have companies and whatever attached to it, but that's where it's different between people that are like billionaires that have companies and real estate and businesses. But that's these people, right? So if you find out that you got one of those on the hook, your whale or whatever, steer them towards a survivorship life policy. Because what happens is, and the reason it's used for estate planning and tax purposes, is if these people die, all of that responsibility, all this falls on the beneficiary. So if they don't have this, then guess what? They got to start putting this stuff up for sale. They got to sell the vacation home. They got to sell this perfect angel's childhood home. How tragic is that? He may have to sell a few of his dad's cars. I'm just kidding. But, he's got to start selling off the assets and paying capital gains taxes and all this stuff. But this protects the assets, the survivorship life policy. So may all of you find one of these a month, and that'll probably pay all your bills for life, because these are going to be big policies. They're going to be millions of dollars, and you can sell them with your regular license, and they serve a very important purpose for your more affluent. So we'll go over a little practice exam here. Then I'm going to take about a 10 or 15 minute break, and then we'll come back and we'll get into some live. These are more just recapping the content we just went over, and they don't necessarily look like how the questions actually look. And you can throw your answers to these in the chat, or you can just listen along. There's a lot in here, so it's up to you. But which type of whole life policy requires premium payments for only a specified period? Don't break your brain on this one. Ordinary whole life, limited pay life, universal life, or term life. It's talking about a whole life policy, limited pay life. So it's premium payments only for a specified period. So next one, in a universal life policy, what can the policy owner adjust? Only the death benefit, only the premium amount, both premiums and death benefit, or neither premiums nor death benefit? The answer is C, the premiums and death benefit on a universal life policy. Which type of insurance policy has cash values that fluctuate based on separate account performance? Whole life, universal life, variable life, or term life? The main word here is separate accounts or various accounts or variable life policies. Number 4, which type of term insurance has a death benefit that remains constant throughout the term? A decreasing term, level term, annual renewable term, or increasing term? Again, don't break your brain on this one. Level term, constant, level. It's common sense. Number 5, which annuity begins making payments within 1 year of purchase? And again, if you're only casually listening or casually reading, you might miss this. Deferred annuity, flexible premium annuity, immediate annuity, or variable annuity. So within 1 year of purchase equals immediate annuity. What type of annuity guarantees a fixed interest rate? A variable annuity, a fixed annuity, an indexed annuity, a flexible annuity. Again, don't break your brain. Fixed annuity. Read the question, read the answers. Low hanging fruit. A survivorship life policy pays the death benefit on the death of, we just covered this, the first insured, the second insured, either insured, or both insured simultaneously. Again, reading the question is really important on this one because you could steer yourself towards D, but it's S, the second, or B, the second insured. That's the S's. A survivorship life pays the death benefit after the second insured passes away. Which feature allows a term policy to be exchanged for a permanent policy without evidence of insurability? And it's one of my favorite products. Renewable, convertible, waiver of premium, or guaranteed insurability. That is a convertible policy. You sell enough of those and you'll be able to actually buy yourself a convertible. Number 9, during which period does an annuity build cash value? The annuity period, the payout period, the accumulation period, or the distribution period? That would be the C, accumulation period. Monica jumps in. Yep, you got it. Monica, C, accumulation period. Good job. Which product combines the flexibility of universal life with investment options? Variable whole life, variable universal life, index universal life, or interest sensitive whole life? I like the way this question is worded. It's actually variable universal life. All right, you second guessed yourself in the right way this time. So here's the way this question is asked that I really like it, because you have to know the pieces of it to get to the right answer. It combines the flexibility of universal life, which we know universal life allows you to change your death benefit and change your premium. And then we know the one that has investment options is variable. So meaning you put it in separate buckets. And then Shamel gets confused with index. So, and then let's submit. We're going to 10 out of 10. Let's go back to that real quick. So, we're sure. So remember, the indexed here is interest sensitive. Oh wait, no, sorry. Forget that. I should never go back. So we're looking at index. So returns are linked to a market index with downside protection. So the downside protection is this one, which we said has like a 3% floor. And then it's tied to a market index, something like the S&P. And then it has generally a cap. Now, that's usually not going to matter for testing purposes, okay? But the main thing is that with indexed, that it's tied to a market index, and it has downside protection. So the questions for your testing purposes is that indexed, and this could be two separate questions, is that it's linked to a market index and that it has downside protection. So for testing purposes, that's the main thing. And then this part is kind of irrelevant. I just want you to understand it, is that it can move like with the S&P. And then again, it has downside protection. So if it does go lower, you have guaranteed. That's the downside protection. It's that low guarantee. Now we're not in a downside market right now. We're in a crazy like bull market, out of control, craziness up here type stuff. The market is just absolutely nuts right now. So again, insurance companies are absolutely feasting right now, but having that downside protection is important. And also remember on the index life and all of these are they are investing cash value of whole life policies. So you're not talking about a huge amount of money. You're not investing the death benefit. You're just investing your cash value. But on a annuity, if you have an indexed annuity, that could be all your money in that. So that downside protection is really important if you have an indexed annuity, like we talked about. Again, returns tied to a market index, and then they have the guarantees. So again, if you end up in a what is it called, a bear market, when it's slow, when it's sluggish, you have those guarantees at the bottom. So it's 650. And we're kind of at a midpoint here. And then I think I'll go through after the break, which will come back at about 7:05 for the break, and we'll get into riders, provisions, and options. The good thing about this section is like provisions and options and exclusions. Those will be health and life. They cover both, so it's good to have those. And then right around 7:30, we'll get into some live fire. Some actual questions from the life and health tests. Every state, not state specific, although we will be in, I believe, a state specific one. I'm not sure what I'm going to use yet. But if it says state specific stuff, generally it applies to every state. When it's talking about the commissioner, when it's talking about the guarantee, all that, it applies to every state. It'll just generally say the specific state. But if you haven't yet, throw your email address in the chat or in the Q&A. And again, once this live is over, I'll send you some materials, some study materials, and then I'll do that later on this evening. And then also keep up with me as you take your exams and let me know how you do. But I'll be back at about, let's say 7:05, and I'll be off audio and off camera for a little bit. I'll see you guys. have returned. 1 minute late. I will write myself up. All right, so we're going to get back into some content here. The next little section. I see Keisha had to go. She's probably already gone. So I was doing some high legs. I sit for a long time, so I gotta get loosened up. Get loosened up so I can cover all this content with you guys. So that's why I'm a little winded. Didn't eat on this break. I am hungry. My wife made spaghetti, but I didn't have time to eat. So yeah, it's very important again because I sit for so long, so I have to do that. I'm getting ready to invest in a standing desk so I can stand and do this, but I've been sitting this whole time. So when I first get up, boy, whew, I mean, I'm not even tell, but I'm old. So you can hear the gears twisting. Oh, which that reminds me. Oh no. Let me go back up here real quick. Somebody wanted to go over something. I believe it was. Hold on. Where was that? Hold on. Right. It's further towards the top here. Hold on. I'm still live. I'm not glitching. I'm looking for a message. It was right here. I did that. Can't find it. If you're still here and you wanted to talk about, I think it was twisting and something like that. If you're still in here, let me know. Let me know what that was again. I can't remember, and I can't find the message. Didn't I? Hold on. I think I copied it. Hold on. Put it right here. Oh yeah, rebating, twisting, and reinsurance. All right. Well, it's rebating is legal. Let's see. Yeah, I don't know where it is in my content, but let's do this. Ooh, I don't like this. All right, let's see here. All right, so the fraudulent, misleading replacement of life insurance policies. Hold on. Churning. Okay. All right. Yeah, we'll do this. Whoop. Churning is the fraudulent and misleading replacement of life insurance policies. Churning is unfair and deceptive practice. So it's kind of like selling one kind of insurance, and then when you actually deliver it, it's not the same thing, and you're just hoping they don't read the policy. I don't want to be on Quizlet. It's all a bunch of ads. It's gonna screw me all up. Fiduciary responsibility. All the premiums belong to the insurer or others received by the agent. And as part of the agent, you guys do collect at least the initial policy premium. You have to send those in and do the right things with them. You can't like spend their premiums and then pay it late. So you have a fiduciary responsibility as the licensed agent. try to find those other twisting. Okay. So twisting is making misleading representations or incomplete or fraudulent comparison of any insurance policies or insurers for the purpose of inducing or tending to induce any person to lapse, forfeit, surrender, terminate, retain, or convert any insurance policy or take out a policy of insurance in another insurer. Um, so a lot of times, what can happen is um, you're going to get on a lot of calls with older folks that already have insurance policies, and they're going to want to talk to you. They don't have much going on. So if you're a happy person generally and interesting, they're going to want to talk to you, and basically you can twist them into changing their insurance policy. I got to get off this. It's like screwing up my Zoom call. Just by being friendly or whatever. So you can basically tell them anything, get them to change your insurance policy, but it's very highly regulated and you got to be super careful. And the last thing I'm going to get off of this because it's awful. It's like absolutely gumming me up right now. I'll be doing life and health for business. What's the biggest difference? Well, I'm going to say easier, I'm guessing. So you're going to be, I'm assuming are you going to be working with like the companies or with the individuals in the companies? How's that going to work, Monica? Help me understand what you mean by that. Is the company basically going to be your client, or are you still going to be working with individual clients? Okay, so I'm going to guess. Okay. Isn't it amazing that that's what I was going to guess? All right. So I knew once you said that, because I've been there before. So here's it's the same thing. Basically, you're going to be working with clients, right? And I'm assuming no, it's okay. Don't be scared. Great company. It was a great company. It just it didn't work. It didn't work for me. So, and it's part of who I am and whatever. It's the reason it didn't work for me. And it's a great company. Don't get me wrong. So here's what I'm going to say. So you are going to be a benefits coordinator. I'm assuming you're going to be working with people in the union. Is that correct? So you're working for businesses. Yes. Okay. So I worked for veterans when I was there. I went the veteran route. It's the same thing. It's basically just like, you're going to be the permanent benefit provider for people that are in the unions. So it's just really where your lead stream comes from. But it's basically the same. And again, great company, extremely great products that they have available to them. I'm not sure what you mean by that combined. I don't know what combined means. But yeah, it's no different. It's basically the same as what everybody does. It's just you're kind of like you're gonna get really good at basically working with certain products. The reason that they're good, and I don't like to talk about specific companies because I don't want to steer anybody towards a specific company. I'm here to help you. Oh, I don't know them. So can't give you an opinion on them. But it just so happens that I kind of understood as soon as she asked her question, I knew where she was at. So yeah, I don't know. But it really, all companies are kind of the same in a way. They all have just kind of their certain slant. And I know Globe because I was there. And I love their product. They basically kind of have they've got a specific type of way that they do things that is amazing for like getting your own referrals and whatnot. And it's just a good system. So I'm not going to say much more than that, but in the grand scheme of things, it's all about the same. It's all about the same. But here's the one good thing about them is they provide your leads. So that's a great thing about them. And then again, they also um, do an excellent job of providing you vehicles in order to create your own referrals, and that is just a huge thing. So, but again, just didn't work for me, but it's good. Uh, I don't want to spend a lot of time on this. We can have a sidebar at a certain point in time. If you want to send me emails on this, I could tell you. But they kind of have like I don't know how far into the system you are, but they kind of have like almost like a combo bundle. As long as they haven't changed, it's been like a year and a half or so, but I'm pretty sure they don't change much. It's probably like Globe Life, American Income is what I'm assuming that you're with. And then yeah, they have just like this really awesome like combo that's like proprietary. It's like their own thing. It's like a combo of like a whole life policy with like an income term package, and then some like disability thing. And it's a really great product, and it's hard to compete with. So yeah, great company. I can't say enough nice things about it. It just didn't work for me, and it's personal. So yeah. And then every company that's represented here is going to have their own thing. You're going to have your own mentors. If you got here based on a company and they've basically got you to this table, like right here, I'm going to endorse them, because I'll tell you a little quick 2-minute story about how I got into the business. And I had a lot of false starts with companies. And then finally, company, it wasn't them that got me to do my test. And I was all stoked on it. Again, I didn't do like exactly what they wanted me to do, because I'm just not programmed that way. My family didn't work that way. I had 2 kids in sports, 1 kid autistic in a special school, and so I just couldn't get everything done in like a week. That's what they wanted, and I just couldn't do it. And I just kind of communicated to them, look, that's just not how I operate. And it took me 4 weeks. But in the 4 weeks, when I went back to let them know that I passed tests, because I was going to like their meetings and stuff, and then I kind of dropped off to just focus on passing my test. And then when I went back to their meetings, that they were gone. They had left and they were like a group, and they went to another company, and I couldn't find them. So I guess they were in like a transitional period. So I kind of got left in the wind for a little bit. So it took me a while. And then again, the next place I landed was Globe. So but that company, that guy, that my mentor, he got me all jacked up to get my license. And then by the time I got my license, they were with somebody else. And I don't think that's very common, but it happened to me. So anyway, I'm a little off my time here. But let's go through this, and then maybe we'll spend like the last hour doing live testing, or we'll see where we're at in about 10 minutes, and then kind of get a feeling from you guys what direction you want to go. But policy riders are optional benefits added to a base policy. Policy provisions, contract terms and conditions. Policy options or choices available to policy owners. And then policy exclusions are things that just aren't covered. That's really changed quite a bit, but you'll see that if we get there. So policy riders, okay, so these are add-ons to policies. So I always kind of use the same example. Again, I'm old. I've said that before. But I was born in the 70s, grew up in the 80s, and then was like in my teen and early 20s in the 90s, which was a great life, like just an absolutely great life to have, because those were excellent decades to live through. But when I was young, I think the first time I ever went to a McDonald's was like maybe 1980, and they all kind of like worked on like their own kind of schedule as far as how they progressed. But so basically, when you went into, okay, Laquisha, you're 70s baby too. Yeah, but you can feel old. I, I've got the gray and I feel old, but okay, I'm a young in the 50s. So, um, but I remember you would go into like a McDonald's or whatever, and they have like a cheeseburger, a hamburger, maybe a chicken sandwich, not even necessarily that, fries, McDonald land cookies, which were amazing. They should have never done away with them. Um, and Well, you're not old, Christy. I'm old. You're not old. I'm sure you're like 29. So anyway, um, oh, 44. Let me tell you something. 44 and 50, they're very different things. They're very different things. My wife is 40. So, and, she complains about being old. I'm like, well, add 10 years onto yourself, and then you're going to feel like what I feel like. So, but yeah, I feel you. No, you're 44 years young. So, but you would go to, right. You go to McDonald's and you'd say, I want a cheeseburger, right? And then they would say, what? You want fries with that? It was all an add on. They didn't have combo meals at the time. You had to add everything. And then you'd say, yes, I want fries with that. And then they would say, you want a drink? And then, yes, I want a drink. You want hot fudge sundae or McDonald Lane cookies? Yes, I want McDonald Lane cookies. Why did you guys get rid of those? You should still have those. They're amazing. And so riders in an insurance, remember 29-cent cheeseburgers? Yes, I do. I remember 29-cent cheeseburgers and 79-cent gallons of gas. That's how old I am. So, yeah, I remember when let's see, a Big Mac, when they did have combo meals, they started like in the early 80s. Big Mac combo was $2.99. And now it's what, like, they have it on special in my area for $8 as a Big Mac combo meal. And I think you get like a small drink and a small fry with a Big Mac for $8. So yeah, but riders are fries. We want fries with that. So when you're offering a policy to somebody, on $1, oh, why you guys got to do this to me? I used to work at a drugstore, and I worked at a corner drugstore back when they had corner drugstores. One of my first jobs. I won't tell you what the name of the drugstore was, because then you would know my first security question on all my internet things. But my first job was a corner drugstore, and I remember basic cigarettes, basic lights was $1.50 a pack when I was selling them, and people would come in and they'd buy basic. I have a really funny story from my time in the drugstore era, but I can't tell it because it would be mildly offensive. I definitely wouldn't record it, but it's funny. Um, but I remember, nope, nope. It was local up where I grew up, and you'd never get it. You could guess 100 things and you'd never get it. It was just a local. I won't tell you anything about it except the fact that I sold cigarettes that every other drugstore on earth sold, and that when I would go into work, I was like 16 years old, and I would get a bag of Funyuns and a Crystal Pepsi to drink while when I started my shift about every day. And it was like $1 for a bag of Funyuns and a Crystal Pepsi in a glass bottle. Oh man, it was good. I loved that. I wasn't even a Pepsi guy, but I loved Crystal Pepsi. And I was a Coke. I actually worked for Coca-Cola when I went to college. But I loved Crystal Pepsi before they did away with it. I was very sad when they did away with it. Well, yes, I did. So, but yeah, I sold basic cigarettes brand, and then we had a paper plant near the drugstore. I'm going to start to give it away. I don't even think you could do a search on this, but the guys would come on their breaks. Oh man, you guys are killing me. You're going to get me on so many rabbit trails. You guys want to learn this or not? But yeah, I was a clearly Canadian guy. I used to play tennis with a buddy of mine, and that was before I didn't work, but he would come pick me up. He was a cheapskate too, but I would make him buy me a clearly Canadian after we I think it was black cherry was my favorite flavor of clearly Canadian. They sell those around still. I still find clearly Canadians here and there. And they're like $3 a bottle or something like that. And I'm sure they're not the same. But yeah, I worked at that drugstore, and the guys from the paper plant would always come in, and I don't know why, I'll just never forget this, but they would buy Benson and Hedges cigarettes, Benson and Hedges menthol 100s. That was the guys that worked at that plant. They all smoked Benson Hedges, and those were more like basic were like maybe $1.50 a pack, and Benson and Hedges was like $2.50 a pack. They were more expensive. They were fancy. And then a lot of the ladies would smoke Virginia Slims, and people would walk in the door, and you knew them by what type of cigarettes they smoked. Yeah, so I can name them all, like Merritt, Benson and Hedges, and Winston, and oh my gosh, all the different kinds of Marlboro Light 100s. Yeah, cool menthol. Yep. Pall Mall, Chesterfield. This has gone off the rails. This has gone off the rails. Yeah. I also sell things on the side, and I found no, you're all right, Christy. Just everybody else is gonna be mad at you. I love sitting there talking about nonsense because I get paid regardless. But I love rabbit trails, but I do like to keep them. We're talking about cigarettes, so it's important that you find out if your clients smoke. It's very important, and if they try to lie to you, and you find out, they could have their death benefit rejected if they find out that they were a smoker and they lied about it. So that's how we're drawing the thing. But again, I was saying I sell things on the side, and I found a Merit hat the other day at somebody's yard sale or whatever, so I scooped it up, and nobody wants to buy it, but it's a purple Merit hat with it's got like a gold rope around the thing, and it says Merit in gold. But I love cool stuff like that, old school stuff. You want my Merit hat? I'll send it to you, because nobody's going to buy it. It should sell. I don't know what you do. You really want it? Yeah, email me. I'll send you my Merit hat. You got to dig it out. I don't know where it's at. A Stetson. Did they give those away? Marlboro probably did give Stetson hats away with Marlboro Bucks or whatever. I remember that was a huge thing too. Marlboro Bucks. Crazy. You guys are crazy. All right. No more rabbit trails. Let's get into this. Jackets, double bags. Yep, I know it, man. The Marlboro stuff was huge. Okay. Where to go? Where to go with this now? Policy riders. Yeah, anywho. So riders are add-ons, and you guys just don't want me to do this. Sam's Club 12 for $18. That's not bad. A little over $1 a piece. I can dig it. My wife goes to Sam's. I don't go there because if I do, I'd spend like $500. So I'll tell her to pick me up a 12-pack of clearly Canadians next time she's in there. She won't. But again, policy riders are add-ons. So like I said before, when you do that, tell me about, and you're writing down things about your clients, you're going to know what riders to offer them. So first thing would be like a waiver of premium. This is something you can pretty much offer to anybody, a rider that waives premiums during disability. So typically when someone's been on disability for 6 months, then the disability rider would kick in and pay their premium. Not really pay their premiums. That's kind of a misnomer. But they wouldn't have to pay premiums during their disability. And then when they, are no longer disabled, then they can start paying their premiums again. And then It's for universal life policies. You don't technically have premiums in universal life policies. It's basically a deduction because a universal life policy is more of like an investment type. So you can, again, you can always change. Remember, with universal, you can change your death benefit and your premium. So you can raise your premium, raise your death benefit as your investments do better. And then you can like use your cash value to do stuff. Universal is just a very flexible type of policy. So instead of it being a waiver of premium, it's a waiver of your monthly deduction. And again, your account's not growing during that time because the insurance company is not actually paying it. They're just waiving it during your disability. And then guaranteed insurability. I think there was an acronym about this on one of those um, flashcards that I made. And then again, this is a rider that allows you to purchase additional coverage, a guaranteed insurability rider, at specified dates. So the dates don't really matter, but it's like 24 years old, 28 years old, 32 years old, 36, and then like 40. It doesn't really matter for testing purposes. And then they usually cut off at 40 because then you become like, as we've just established, at 40, you become a higher risk thing. So, and then when you have a guaranteed insurability rider, the good thing about that is you don't have to go through underwriting again. You don't have to do a health chart or anything like that. And you can add coverage. So that's good for your young type people. And you can do these on a term or a whole life. They probably make a lot more sense on a whole life policy. But if someone gets married or they have more kids, they can add to their life insurance with a guaranteed insurability rider. I think those kind of always would make sense unless someone is like older. Maybe a guaranteed insurability rider wouldn't be that important because usually when someone gets older, they're looking to offload insurance as opposed to actually adding insurance because they don't have kids at home, their houses maybe are paid off or something like that, so they need less insurance as they get older. And then you have a payor benefit. Typically, like a juvenile policy, you have a payor benefit, meaning it will waive the premium if the payor dies or become disabled. So the payor would be a parent. It's on a policy for a kid, and you get a payor benefit. So if you pass away or become disabled, then that premium gets paid or gets handled until the juvenile turns 21. So they have that death benefit, and then they can take over the policy when they become 21. Usually on the payor or on the juvenile policies, it is till 21 till they become like responsible for the account. And then we already kind of covered accidental death and AD&D. But with accidental death, it will double or triple the indemnity for accidental death. Like I said, this would be for someone that's like a regional manager or something, and they travel a lot regionally by car. You get them an accidental death policy, and then if they have a face value of $100,000 death benefit and they die as a result of an accident, the death benefit pays out $200,000 or $300,000, and that could be on a term or a whole life policy. It doesn't matter. Obviously, on a whole life policy, it would cost more. But yeah, an accidental death rider, and then accidental death and dismemberment. If someone, like you always use an example. I have a friend who worked in a factory and he did maintenance on industrial rollers. And the only way to diagnose a roller to see if it was malfunctioning was by ear. You actually listen to it. So he would have to go up and get near these rollers as they were functioning, turning at a very high speed. And he did this for years with no incidents at all. But he had a new person that he was working with. They always worked with a spotter that would be like by the safety switch just in case they got too close to the roller or something, or maybe if their sleeve got caught or something like that, that spotter could shut it off. Well, he was working with a newer spotter, and he got his arm caught in the roller, and it took the spotter like way too long to shut that off. So he had an AD&D policy, lost part of his arm. and so that paid out for him being dismembered. Of course, then he also got a big old like workman's comp claim settlement also because of that incident as well. So, and that also would cover like a loss of sight or a loss of hearing. And generally, those are a separate like indemnity. Yeah, he's doing all right. He actually was married to one of my old bosses, and I see like what they do now. And of course, I was on the inside, so I kind of knew what happened to him. So yeah, they have lots of toys and lots of vacations. And actually, he didn't technically lose his whole arm. I won't tell the details. If anybody's squeamish on here, you don't want to hear the details. But he actually was able to have his arm repaired, and he has like 60 or 70% usage of it or something like that now. And it looks really funky. But yeah, they're living good. Not sure I would say it was worth it. Yes, he can. I'm not saying it was worth it, but he deserves what he got. It was a really big steel company that he was working for, and yeah, they paid a big settlement. But man, they made him wait for it for a long time. Ooh, it was brutal. It was brutal. So that's an AD&D writer. So again, if you got a customer and they work at a place like that, you can tell them that story and pretend it was your friend, and then add on a AD&D writer for that person. So here's some other writers. So you have a term writer. So if someone has a whole life policy or a permanent life policy, and my Globe person, you're gonna know the whole permanent terminology, because that's something that they use a lot, because anytime you have benefit, and this is good for everybody, by the way. If you have benefits through your employer, those are temporary benefits. Okay. So that's how you have to let them know. If you leave that job, you can't always take those benefits with you. And if you do try to take them with you, they're generally going to cost you a lot of money. If you start paying for those benefits on your own, either through COBRA or through some sort of a transition, like if the life insurance allows you to take it with you, you're just going to pay a lot for it. But when you're talking to somebody, you're providing them quote unquote permanent benefits, and you're going to know what I'm talking about. These are things that you have that you control, and you're not trusting your employer to control them. But a term writer adds term coverage to a whole life or a permanent life policy. So you can have, say, $100,000 whole life policy, and you can add a $100,000 term rider to a whole life policy for 10 years. So for that 10-year period, if something was to happen to the insured, then the death benefit would be $200,000. So that's a cost-effective way to add coverage to a whole life policy. And usually as a writer, it's a little bit cheaper. But again, always remember that as you're adding premium, your commission goes up. So it's important. And then you have other insured. So you see a lot of these other insured policies when you get like a policy with an employer or something like that, where you have the primary insured has a $70,000, $80,000 death benefit, and then maybe like 25,000 for the spouse and 10,000 for each kid. That means it has an other insured rider on it. So everybody kind of has their own individual policy under one main policy. And then LTC, we saw that acronym earlier, long-term care. So that just accelerates a death benefit. So it's a living benefit for a life insurance policy. So if the insured has to go into a long-term care facility, then the death benefit pays out a portion and pays for that long-term care. Hey, come here. Come on up here. So you guys get to meet my dog. So look, you see yourself? That's my baby. So, I really don't even like her. Just kidding. Her name's Ellie. So she's a golden doodle. Thought you guys might like to meet her. She's a mini golden doodle, and she made 6 other golden doodles last year. We had puppies. So, yeah, I knew you guys would like that. The best thing to do is break up the monotonies with a dog. So, um, man, she didn't feel mini when I just picked her up. Holy moly. Um, so again, long-term care, you go into a long-term care facility and you're there for more than 6 months, then the benefits kick in and then pay out for the long-term care. And if you've ever dealt with like a family member with long-term care, you know they're blood-sucking leeches, and they will make you sell houses and cars and liquidate assets and take retirement accounts. So having these will, if not like fund your long-term care facilities, they might land you in a nicer one, because there are definitely levels of long-term care facilities. I will tell Ellie you thought she was cute later. And then a return of premium. We talked about the return of premium policy. So that's basically where that's what the policy is. It's a return of premium term life policy, but you can also add a return of premium rider to just a regular term policy, or you can start stacking these. Okay, we're going to use my pen here real quick. So let's say you start with a whole life policy, and then you add on top of it, you add a term rider onto that. So you got your whole life policy, and let's say the main portion of the whole life policy premium is like $100, and then you add a term rider on top of it, and that's like $25. So this is where you can kind of sell something as a premium and basically say you're going to rent this, but you're going to get it all back. So you do a 10-year additional 100,000 on top of that. So you have a $100,000 whole life policy, then you have a term rider, another $100,000, and then you add a return of premium rider onto the term rider. So meaning over 10 years, they're going to pay an extra $25 for their term rider. All right. And then at the end of the 10 years, when that goes away, they get all that back. So what, 25, that's $300 a year over a 10-year period. So they hold on to that for 10 years and they get $3,000 back. So you're stacking those, and then they can either take that $3,000 in a check, or they can maybe pay part of their premium for the next year or something like that. Who knows? But it's just kind of a make sense thing to build value into these policies, where it increases the premium for you, for your commission. It adds value added features and benefits to these policies. So I'm a big rider fan. And you know I love return of premium, so I love that one. And then income protection riders, disability income, which is monthly income during a disability. And again, this is done as a rider. You can have a separate like long-term disability plan or a separate short-term disability plan, but this is a rider on a life insurance policy. So again, pump up that premium, pump up your commission, and then also add another benefit for your clients that's very value added. And that, it's kind of bundling, right? Like it's just adding this insurance bundle. Maybe that's the way that the client is wired. Like they love bundling. I personally don't like bundling. Like I had internet and phone and TV all in one bundle. I barely ever used the dumb phone, and I barely ever used the stupid TV. So I was paying way more for internet than I needed to, but the only way you could get internet cheap is by bundling. And if you literally just got internet by itself, it was more expensive than the bundle, but I hated it. But this is a way, again, that if you have that client that's bundle minded and they love it, then use these riders. So disability, you get some monthly income during disability, usually works the same as a disability policy where you get like 60% of your income while you're disabled. But on these insurance policies, it's generally not long-term, it's generally short-term and has like, it'll give you income for like 6 months or 12 months or 18 months or something like that. And then, this one's probably not super cost effective. They're probably a little more expensive for that rider, but maybe they want it. So you want to give it to them. And then cost of living, this is another good one, also known as a COLA um, rider. That's a good acronym. I like that acronym. It makes sense. Cost of living. So basically, the rider increases the death benefit based on inflation. An inflation index is called the CPI, or the Consumer Price Index. And it's basically what, you know, adds to your, like when you go to get a raise and you want a cost of living raise and they give you like 3%, it's based on the Consumer Price Index generally. Um, Ashley says, what is the best way to study the areas that you struggled with in the comprehensive assignment? So again, one thing that I do for you guys, if you guys send me your transcripts for, you know, whatever areas that you struggled in, is I provide you a targeted study guide. And again, I don't want to tell you how to do it necessarily because I don't want to be blamed. But the areas that you know you're super strong in, don't spend a whole lot of time on them. Just skim those, reinforce your knowledge, but then drill down on those areas that you're weak in. And then again, if you're 5 or 10 points, you know, that you fell short, and you drill down on those areas that you were weak in, and you get much stronger in those areas, you're going to fly through the next time you take it. Like, because you're going to pick up those extra points. And then also on what you did well the first time, don't second guess yourself. You know, you're going to get those again. Yeah. So, yeah, no, you will. Not hope, you will. I almost guarantee it. So again, reach out to me, and I'll help you in any way I can. I got some study guides to make later on this evening or possibly tomorrow for people. But I'll send everybody out some basic materials after the live is over. Usually I go and put my son to bed for a little bit, and then I come back around 10 o'clock or so, and then I send out the stuff. So I try to get it in before midnight. All right, all right. Don't think I'm gonna get much further. Pauline says, don't go back during the review part of the exam. This killed me. I changed my answers. Yeah, that's a good suggestion. Paulina said, don't go back. And I'm not telling you 100% don't do it, but I agree with Paulina as that I think it's safe to go with your first instinct on this. Trust your preparation. And so when I made this here, hold on, where'd this go? Let's see, where does it say this? What's the one I want to look at? I know it says it on here somewhere. Yeah, there we go. Stay positive and trust your preparation. So when I created these slides, again, I do everything with a plan, and I do everything not just using my own knowledge, because that's fallible. This I got from a bunch of different sources that help people pass professional licensing exams. So that's where all these slides came from. So it's not just me saying it. It's not just Paulina and Christy saying it. The experts say, trust your preparation. And part of trusting your preparation is not second guessing yourself. Welcome back, Monica. That happens. So yeah, so trust your preparation. So I think at this point, I think the best thing for us to do is transition into some of the live content and go over some live test questions. I'm not going to get far enough into the materials to do you much good. And I think the test questions, the live test questions, do allow us to stop and review in and of themselves. So let's do this. Might take me a minute to get where I need to be. All right, and I want to do, hold on, specific one I want to do. I think it's this one I want to do. Nope, that's not the one. Hold on. Or that, okay, yeah. Figure out this is what I want to do here. Is this it? Oh yeah, this is it. Yeah. So just kind of ignore the fact that it says Idaho. It doesn't matter. It's good for every state. But yeah, let's see. This is probably gonna say I can't do it. Okay, well let me resume. No, it won't allow me. So I gotta go to this one. Bear with me. This should let me do it. So I'm gonna have to go through these, and then at some point I'm gonna have to have reset these for me. But right now they're good. Okay, so these are actual exam questions that you are likely to see on your state exams. So when it says Idaho, don't focus on that. It's basically for every state. If I see something that's like not specific to another state or like wouldn't be specific, I'll let you know. But these are mostly general. And then the ones that say like Idaho, if they have anything to do with the commissioner or the guarantee association or the governor or anything like that, that's every state. So here we go. And you guys can, we're down to like 28 people. So you guys can just listen or if you want to, you can participate in the chat and give me the answer that you think that it is. And then um, once we answer these, if it has anything like too complicated, it'll explain in the bottom. So you guys are getting ahead of me. Life insurance applicants are classified into risk categories based on their educational background, employment type, marital status, age and health history. And it looks like everybody is on the same page there. Age and health history. And we got that one right. And the reason I like doing this exam is because it gives me the right or wrong answers right away. And it gives us a little blurb about it, unless it's just like super duh. But I'll go ahead and read this as well. It sounds like you guys got to have it. You already have this one down. Life insurance applicants are categorized into different risk classes, primarily based on their age and health history. These factors are critical in assessing the likelihood of the applicant's life expectancy and potential risk to the insurer. So yeah, I won't get too deep into that one. Looks like you guys have a good grasp of that. So, what type of risk is insurable? Operational risk, speculative risk, investment risk, or pure risk? And this is you guys that recently took the exam, you can pretty much confirm with me that this is likely to be on your test. So, and everybody's saying the same thing. Pure risk. Pure risk, only pure risk which involves the possibility of loss without gain are insurable. So these other ones are not. So you kind of use this one, you got to know it one way, and then the rest is by the process of elimination. Because, again, no insurance company wants to insure somebody who just wants to go make their own investments, right? That's too risky. But pure risk is just by chance. A policyholder undergoes an elective surgery. Now, this would be a health question. Without obtaining a mandatory second opinion, what is the most likely consequence? So this is a good mix of life and health. So we won't leave the health people out in the wind here. The policyholder may face higher out-of-pocket costs or claim denial. The insurer will cover the full cost of the procedure, the provider will reduce the cost of the surgery, or the policy will be canceled for noncompliance. So it looks like I think like those are a bunch of A. So I'm gonna hesitantly tell you my unwritten rule as well. So A. So many insurers require a second opinion for elective surgeries, and yeah, cosmetic surgery. Exactly. So Christy, I'm about to blow your mind here. And I don't know if you've been in some of my recent ones of these, but and again, this is not foolproof, okay? I would never base all your testing on what I'm getting ready to say. All right. So all right. I'm so hesitant to say this, but it's weird because as we were going through these, and I've gone through a bunch of these now, and it holds up almost 100% of the time. It's crazy, crazy. So it seems like, I know, I'm qualifying it too much, but it seems like that the longer, more drawn out answer is generally the right one. Yeah, Monica was here. And it's crazy because it seems to hold up. And I'm not saying that you just base it. So you see how these answers are shorter, right? And then this one is longer. It seems like the longer answer is the right one. And we're gonna judge this as we go through more questions. It doesn't always work, but I think that it's because when they ask the questions that they do like kind of like more simplified incorrect answers, but the true answer is more complicated, and that's why it tends to be longer. Now, don't just scrap your preparation and use this rule, but it might, yeah, so it might help push you over the top when you take your test the next time. So, and if it really starts to work, I'm going to start charging people. Oh, Monica says it will fail you. Yeah, I'm gonna be like, I want to do like a viral YouTube video that says a guaranteed way to pass your insurance exam for the first time. No, don't. But I'm just saying, maybe it helps get you down to a 50-50 answer, and it'll help you. But so yeah, let's see how this goes. I don't give any guarantees. No way, no. See, like this one doesn't work. They're all too close in length. So, but we'll see. We'll see. So Jack is a licensed insurance producer in Oregon and wants to sell insurance in Idaho. What must he do? Establish residency in Idaho before applying, retake the licensing exam, sell insurance in Idaho without an additional license, or apply for a non-resident producer license in Idaho. All right. See, it didn't work here, but again, they're all too close in length for it to work, but you guys got it. D. So that's a crossover state. And Monica says, when my test anxiety kicked in, I reverted to that on some. Sorry about that, Monica. My bad. That's my bad. Should have never brought it up. I can't help it though. It's so weird, like the way that it works. You got to take a Xanax or something before you take your test next time, so you calm down. But yeah, so crossover states. The only one that I know of that's not a crossover state is Florida, and where if you live in Florida and you're testing in Florida and you want to do business in another state, you literally have to take every state's test, which is a bummer. That's a bummer. That's what, because I have, so not to belabor a point here because this is not super relevant. If you're not in Florida, yeah, okay, so you understand what I'm saying. You just think it's crazy. It is crazy. And do we have any Florida people here? If we have any Florida people here, are you? Oh, so you're taking your Florida license, right, JG? Yeah. Well, if you want to do business in Ohio, you also have to take an Ohio insurance license. Florida is not a crossover state, so Um, yeah, Justin's in Florida. Yeah, Junior's in Florida. It means if you want to do business in another state, you have to take the license. Well, okay, so it's bad, it sucks. But here's the good part, right? The good part is if you can pass the Florida exam, well, that's because you're in Florida. But the good thing about me being in Ohio, like I wanted to do business in Michigan, so I just paid $35 and I can do business in Michigan. And I also wanted to have a West Coast presence so I could like sell into the evening. So I got my Arizona license as well, and it cost me $80 or something like that. So, but I only had to pass my test in Ohio. So, but the good thing is for you Florida people, if you can pass your license exam in Florida, you can pass it anywhere. All right, so let's go to the next page. But for you Florida people, you would answer that last question wrong if you answered that. So in a joint life policy scenario, which event triggers the payout of the death benefit? And we covered this. The death of the first policyholder when the surviving policyholder remarries, the policy anniversary after both have died, and the death of the second policyholder. So it looks like everybody's saying A. Again, my unwritten rule does not apply here. And again, these are all, it's not really when they're really close in length. It's when there's one that's significantly longer than the rest, seemingly. A joint life policy, also known as first to die insurance, the death benefit is paid out upon the death of the first insured individual. And also know on these policies, it's paid out to the other person that's insured, not a beneficiary. All right, which provision allows the insured to transfer some? We didn't cover this, but hopefully you know it. The insurance to transfer some or all the ownership rights of the policy to another individual. Great grace period, consideration, assignment, and then time limit on certain defenses. This one also would not apply. It's not apply in my rule. I think most people are saying C. It's assignment. So assignment provision enables the insured to transfer policy rights either fully, which I do like doing these tests this way because we can still cover the content. So absolute assignment is fully, or partially, or a collateral assignment is partially. So to explain this a little bit further, a absolute assignment would be if you basically, yes, that question definitely, this will probably definitely be on the test. I say probably definitely. So absolute assignment is also known as like a viatical type settlement. When you're fully assigning over a policy to a company that basically buys your insurance policy from you. So you can like do a surrender on a whole. Now these are on whole life policies, by the way. Nobody's going to buy your crappy term policy. If you have a whole life policy that has cash value, that has a large death benefit, that's paid up current, then a company, let's say you have a $500,000 whole life policy that has a $50,000 cash value. Well, a viatical company will swoop in for whatever reason. Maybe you become terminally ill or something like that. And you need the money right away. And they'll give you $300,000 for your $550,000 policy. And if you were to basically settle it with the insurance company, they might only give you $250,000 of it. They'll only give you half generally. Now that's changing. Okay. The insurance companies hate viatical settlements, so they're changing rapidly to give higher surrender values to their insurance policies. Yeah, it's kind of dirty. Well, viatical just basically means like taking over. But yeah, it can be shady to a point. But if you think about it, if someone's in a bind like that, if they're terminal or whatever, and they want more access to their money, and their insurance company's only going to give them half, they kind of know they only have like 12 to 24 months to live, then, getting more money is better. Even though, yes, these viatical companies are basically betting on you to die. They're going to benefit when you die. So they give you more of your money. And then when you die, yeah, they make probably 25 to 30% of your death benefit. They make that money in profit. So yeah, it's kind of gross, but at the same time, it's kind of serves a purpose. Just like vultures serve a purpose, they get rid of the dead animals off the side of the road, right? So I don't say I want to work for a viatical company. I would feel very dirty if I did work for one, but they do serve a purpose. And then a partial uh like assignment would be like you going to get a loan and maybe your credit's a little shaky, and you can do a collateral assignment to a company to get a loan or to get better terms on a loan. And then once that loan or that note is paid off, then the rights of the policy come back to you. So you can get your policy back. You're just using it for collateral for a short period of time. Much less skeevy than a viatical. But also remember about a viatical settlement is they take over the policy completely. They start paying the premiums and everything. They fully own it. So you don't have to make payments on it anymore either. So they are taking a bit of a risk when they're doing that. So that would be that. And yes, that's very testable stuff right there. So Amy purchases a new health insurance policy and is concerned about whether it will cover basic health care services. Let's skip this one. Sorry, Idaho, because this is really Idaho specific. Idaho's minimum standards ensure that Amy's policy includes blah, blah, blah. Never mind. Just skip that one. Forget that even existed. Group life insurance. This is pretty good for everybody. Group life insurance generally covers employees of a company without the need for employer contributions, beneficiary designations, individual medical exams, or monthly premium payments. C. I agree with your C's and I will match you a C. Exactly. And it's just, there's not even anything to explain. Group underwriting uses what's known as the law of large numbers. And that is something that you might see on an exam, the law of large numbers. Basically, it underwrites the whole group instead of individuals. So just know that in a group policy, the way they underwrite is utilizing the law of large numbers. I wish I could implant my brain into you guys for a short period of time, only for the purposes of taking your test. And then you have to return it after that because everything else is going to be crazy. So what is the taxes for that? For you ain't gonna want to keep my brain. That's bad news. That's bad news. The taxes for company or whatever providing group insurance, law of large numbers, or the tax free. Oh, that really doesn't apply. So I will say this: when a company provides benefits, when they pay for benefits, there is generally a tax break for companies, and that is something that you could see a test question on. But whenever a person is paying for their own insurance through a group policy, then they don't get any tax benefits for it. And then also the other taxing questions are pre-tax and then post-tax, which is what's the terms I'm looking for? Crud. Broken. But there's two terms. Roth IRA is after tax money, just so you know. So when you do start drawing out of a Roth IRA, as long as you're at retirement age, you don't pay taxes on it. And I think it's 59 and a half, how that works. So 60 basically, and you don't pay taxes on it. But there's a term, is it participating and non-participating? Nope, that's dividends. Crud. there's two terms, and my brain is fried. I know it. If I saw the content, I would know it. Maybe we'll get to a question that covers it. But the main difference between simplified issue and fully underwritten health insurance policies is that simplified issue involves minimal health related questions and no medical exam. Oh, my rule might work here. Is only available for individuals under 40, applies only to employer sponsored health plans, or requires detailed medical exams for approval. It worked. That's question number 2, that it worked. Simplified issue policies require, no, it's not what I'm looking for. This drives me crazy. But yeah, the rule, yeah, Kareem says the rule helps. I swear it does. We've seen it over and over. Hold on a second. Let me see if I can, I'm gonna hold on. I'm gonna go here. Let's see if I can find that tax term, because I do notice a lot of people struggle with the tax stuff, and so it wouldn't hurt us to cover it real fast. Uh, uh, hold on. Now, and it's gonna break my brain. There it is. Qualified. Qualified. Yes. So, qualified plans. We're going to get a study sheet you were looking at. That's what I send. If you put your email address. Now it looks different because I can't send my slides because you have to have the program that I use to create the slides. But my PDFs have all this information in them. So if you put your email address in the chat, when I send you the study materials after the live is over, you'll have all of this stuff. But yeah, so qualified plans have tax deductible employer contributions. And then, yeah. And then non-qualified plans, no tax deductions for contributions. So for the basics, kind of easy. Non-qualified plans, no tax deductions. Qualified plans, yes, tax deductions. And then again, there's a lot more to it, but we'll get back into the test questions. But you're gonna study that stuff on your own. But yeah, I get that. I get that. So, like I said, when someone asked me earlier, if you only attend my live, what question, how much, what will you, someone said, if it was Lincoln, I think was his name. If you only attend my live session, what score would you get on the test? And I guarantee you a 1. You'll get a 1%. That's about all I'll say, is I think I can get you to a 1, and the rest you got to do on your own. But if I was really, really gauging it, I think maybe I could get you a 10. But you got to study on your own. This is just an extra study session. I want to give you tools. It's kind of the whole thing. I've never said this before in life, but you teach a man to fish, you feed him for life. Or if you give them a fish, you only feed him for that meal or whatever. So that's why I try to have tools where I teach you guys how to fish. So, and that's what the study materials are for. A standard provision required in all group life policies, and just ignore Idaho because it's everywhere, is mandatory participation in a wellness program. A grace period must be provided for premium payments. Coverage must include both life and comprehensive health insurance, and then an automatic increase of coverage amount every year. I'm gonna have to go by the process of elimination. I don't think it's that. This is kind of dumb. I'm actually going to say B, but you guys are all saying C. I'll answer it C for you guys, but I'm thinking it's B. It's B. So here's the thing. This is where my rule didn't work. The rest of these, it's not really Idaho either. This is everywhere, by the way, because this is one of those questions where the answer is like almost too simple and you overthink it type of a question, because literally none of these other things have anything to do with group life insurance, like literally nothing. Because again, you look at this one and it talks about life and comprehensive health insurance. That has nothing to do with group life insurance. And then an automatic increase of coverage amount every year, that's a COLA rider, right? And then this is just dumb, like mandatory participation in a wellness program. It's not going to apply. So it's a super like weirdly simple, like, but even on this is where you got to know the content backwards and forward. Okay. So on a group life plan, the um the grace period is different. It's I think it's 11 days, okay? Or 11 is the minimum and then 30 days is the maximum. So how that works is if you get paid like weekly, then you take like let's say you take an unpaid week off or something like that and you don't pay your premium, then they're going to be okay with that to a point. And then once you get past like 30 days, like then they're going to start to assume, well, you don't even work there anymore, right? So that's why they give you like that grace period. It's like 11 to 30 days or something like that. 11's like the minimum, but it's generally like a month. So, and again, it's just like the only answer that applies, but it's super confusing because it adds all this other stuff that just kind of is like gobbledygook. So again, it didn't even answer, like it didn't even give us an explanation because it doesn't know how to answer it. All right, here we go. So again, this is kind of a weird thing right here that is talking about things, but it's mentioning states, and it's also this is trying to distract you. Okay, the question's trying to distract you, but there's only one right answer to it, and it has nothing to do with New York and Florida. So ABC Insurance operates in New York, where it is chartered, but also sells policies in Florida. What is ABC Insurance classified as in Florida? Domestic, surplus, alien, or foreign? Seeing all different answers. Shamel, you got it. Paulina, you got it. Yeah, it's weird. Okay. So it's foreign. So here's the thing, and I'll try to cover it to explain it. And just to make you guys that answered it wrong feel better, 3 live sessions ago, I also answered it wrong. And I like stood by my answer, like kind of like a man does. Like I know I'm right and I was wrong. And so I am fallible. So foreign insurer is someone that's chartered in one state and then also sells in another state. But alien is actually from a different country. Okay, so they're chartered in a whole different country and they operate in the States. So that's an alien insurer. So I guess in that case, you think about it in the terms of immigration. Like if you have someone that's a an illegal alien or an alien, you can be a legal alien. So but it's foreign. What's surplus? I don't even know. I kind of know what that is, but from a testing standpoint, I don't really know how to answer that one. But I know alien is for a different company, and then a foreign insurer is a different state. So it's kind of confusing though. But again, all this words in this question was just to, I don't know. And a domestic insurer I know is in the same state, but the surplus lines I don't know. But domestic is in the same, like you're in the same state. And surplus lines, I'm not sure what that is. But yeah, so let's see if we get another one of those. All right, this one, you guys should get this one. Yeah, Alien's another company. I said that. Like I said, like if you have someone immigrant, they could be a legal alien or an illegal alien. So a decreasing term insurance policy death benefit blanks over time, remains constant, increases, fluctuates, decreases. And I'm gonna be so mad if any of you got this wrong, because the answer is D for duh, decreases. Like decreasing term. Don't overthink it. Yeah. Boom. Decreases. So like mortgage life decreases over time. And I think it's a gimmick, but hopefully you're here and you heard that. Yay, everybody got that one right. We got about 40 minutes left in this session. Appreciate your guys' participation. And again, if you haven't yet, drop your email address in the chat or in the Q&A, and I'll send you some study materials after the live is over. And I have a lot because this one got big, so I have a lot to email to. What is a benefit of choosing paid up additions dividend option? We did not cover this, but maybe my rule applies. Accumulating dividends at interest, increasing the policy's death benefit without additional premiums, receiving dividends as cash payment, or using dividends to reduce future. And everybody's using my rule. You're all cheating. That is correct. So paid up additions. So these are on companies that, but you get it right the next time, right? You won't get it wrong again. So paid up additions are when you have a participating company. Little extra credit here. What's another name for a participating insurance company that offers dividends? In the chat, a little extra credit, which give you, there we go. Paulina got it. Mutual. It's a mutual company. Christy, getting there. So that's the opposite. A non-participating company is a stock company. So participating would be like your Mutual of Omaha companies. They're owned by the policy holders, whereas stock companies are owned by the stockholders. So when there's profits or dividends, they're paid to the stockholders. And then with a mutual company, since they're owned by the insured people, basically, that's when they give dividends, or they pay out the profits to the insured. So the paid up dividend option allows policyholders to use their dividends to purchase additional paid up life insurance. It increases the overall death benefit and cash value without requiring additional premium payments. Paid up additions are fully paid and do not require further premium, making this option an effective way to enhance coverage and grow the policy value over time. Hey, if you just gain one more question or one more answer, it's going to be beneficial. So stick it out. These word questions are super helpful as well, because again, there's a lot of these on the test. John is considering a term life insurance that he can upgrade to a more permanent solution as his financial situation improves. What features should John look for? Convertible, indexed, fixed, or renewable? I did cover this. Looks like everybody got it. So convertible, kablooey, and I won't even read all that. Keisha got it in at the buzzer. I won't read all that because you guys got it. So I will just say it again. So you have a term policy and you get convertible. You get a convertible term policy. It's a whole thing, right? And then at the end of the term, you can change it over to a permanent or a whole life policy, convertible. Good job, everybody. An insured disagrees with their claim settlement and hires someone to advocate on their behalf. Which type of adjuster does the insured need? A public adjuster, an actuary, an independent adjuster, or a captive adjuster? I think I know. I have it down to two. So I have it down to B or C, actually, is where I'm at with this. Definitely not. I don't think public. If you're hiring them, you have to hire somebody. It wouldn't be public. I'm gonna say actuary. Might go because I think we have more B's than that, but I think it's actually C. Oh, we were wrong. Who was right? Lakeisha, you were right. Paulina, you were right. Public adjuster. Public adjusters work on behalf of the insured to negotiate claims with insurers, often for a fee or a percentage of the settlement. I'm fallible. I'm fallible. Apparently, we're all fallible, right? But we learned something, right? I haven't seen that question either, Monica. So I'm with you. I just honest to God, I just didn't know. I was just going by what I assumed. So I've never really seen much questions regarding adjusters, period. But now we know. Now we know. So, and I know this is right. This comes straight from Pearson. So, what is the primary function of a credit report in health insurance underwriting or life? To assess the applicant's ability to pay premiums, to evaluate the applicant's health status, to determine whether an applicant qualifies for Medicaid, to review the applicant's previous claim history. Does anybody want to say what type of how we should answer this question? I think it should be process of elimination. Okay, so what's a credit report going to help us when it comes to health insurance underwriting? We got every answer. All right. Well, I'm going to go with the process of elimination. I'm going to go A. Okay. So, yeah. So A. So basically they're pulling a credit report, to see how their payment history is, the ability to pay premiums. And it's same for life insurance as well, life or health, both. They pull a credit report, because even though because we know what kind of contracts are, it's not even that really, Vivian. It's not how much policy they can afford. It's just the fact that there's no like detriment to not paying a policy. Like if you walk away from a policy, like they're not going to report that to credit or anything, life or health, either one. That's why they're basically what's the term I'm looking for? They're unilateral policies. Basically, they don't want to go through the hassle of extending you an insurance policy, a health insurance or a life insurance policy, if you're not, you don't regularly pay your debts. So, but usually you can still get one. What they'll do is they'll handle it through what's called rating. Okay. So this is just so you guys understand. If you're dealing with a bad credit, type person, you still probably can do the thing. You're just going to have a higher premium. It's going to be rated higher. So good for you. You might make less of a rip on it or less of a commission, but you'll make some commission instead of having to turn somebody down. It happens. And, don't judge lest you be judged, because we've probably all been there. So, all right, next one. Which provision allows a policyholder to recover premiums if no disability claims are made over a set period? A waiver or premium, change of occupation provision, return of premium provision, or guaranteed insurability rider. So this one, we didn't cover it, but you guys are getting it. So yeah, kind of the same as the life insurance thing that I love. Return of premium provision. Boom. Refunds a percentage of premiums if no claims have been made. That's kind of a make sense one there. My regular special rule does not apply. Got 30 minutes left. All right, a policy holder. I don't know if you've noticed, but my voice is about to go. Apparently, I got to take 2 breaks. A policyholder with a variable whole life policy would expect cash value to blank depending on the performance of the underlying investments. Decrease, stay constant, fluctuate, or convert to annuity. Looks like everybody's saying C. I agree to that because it's the only thing that really makes any sense. In a variable whole life policy, the cash value is invested in various sub accounts, which can include stocks, bonds, or other investment options. So you guys all got that one. So I don't have to read all that. Tom's life insurance policy includes a disability income rider. What benefit does this provide to Tom if he becomes disabled? Okay, yeah. So this is a good one, right? This is a really, really good one. This is where you have to really, really read the question. Okay. So Tom's life insurance policy includes a disability income rider. Which benefit does this provide to Tom? So a lot of people are answering D, and that is the correct answer, D. So it's this. I'm glad this like question showed up because the rider, if it was just like waiving the premiums, it would be a waiver of premium. But providing income makes it a disability income rider instead of a waiver of premium rider. So that's what it does. So the key term here is a disability income rider instead of like a waiver of premium rider. So it's like one like the yeah. Watch the wording. It's really important to read the wording closely. And again, it like will trip you up because it literally like sometimes they'll put like the word disability down here or something like that to try to like lead you towards that. But again, I like the way it did this. That way it can show us how important it is to read and understand the question. All right, so this we didn't get to, but this one's very testable. This shows up on almost every test. Is what does a spendthrift clause in life insurance policy do? Waives premiums during disability, allows policyholders to change beneficiary, increases the policy's cash value, or prevents creditors from claiming the policy's proceeds. Special rule, folks. Special rule. D. So this is another one where you can kind of win a bar bet with this, and I think there's a lot of no, it's just D. So this is one that there's a lot of misconceptions around life insurance in general and it's kind of caused by like the collections industry. So I'll give you a little example. Like when my mom passed away, she had a lot of creditors, and I was listed on a lot of her debts or whatever. So they would obviously call me after she passed away and try to collect on her debts, and they would say, well, you have to pay them out of her estate. And I would be like, what estate? She didn't have one. Like after her funeral was paid for and everything, there was $800 left. And so usually I would like literally say that. I would just be super honest, and they would just hang up on me. There was nothing they could do. I didn't even know about the spendthrift clause when I was doing that. I got someone asked earlier, and I never answered the question: is how long ago did I get into this? It was 3 years ago that I got into the business. That set me through the roof. You got mad about that they did that. It was, yeah, it did. It didn't send me through the roof. I just laughed at them. I'm like, whatever. But yeah, I understand what you're saying. How disgusting that was. Of course, the thing is they didn't know. So they didn't know. They just knew she wasn't paying her debts anymore. And I would basically tell them that she passed away. And that, yeah, you're saying like skeevy. Once I told them, because once you do that, so because some people will like lie and say, like let's say I have a debt and that someone calls and I answer the phone and they say, hey, you owe X amount of dollars for whatever, and I say, oh, he's dead. Like I'm not him, he's dead. Well, just so you know, don't do that because once that happens, then that creditor will go and they'll put you on a death list. So my years in the mortgage industry is when I realized this, because we would, yeah, don't do it because it causes a big bunch of problems. So we had people, we would pull their credit and we would, then the next thing we have to do is like verify who they were. And like, we would say like you're dead, like your credit says you're dead, like what happened? And then usually they would laugh and be like, oh yeah, I did that, I told a creditor that when I had bad credit or I lost my job or something. And then they would have to go through all these steps to prove to the credit bureaus that they were still alive. So, and it was generally a hassle and it slowed us down. And yeah, it was something. Yeah, it was crazy. Like you'd have to do some crazy things. So don't do that. Which of the following types of insurance provides financial protection against medical expenses resulting from accidents or illness? Disability insurance, workman's comp, medical expense insurance, or life insurance. So there's one best answer to this. Um, yeah, there's one best answer to this. Oh gosh, sorry, I have a cramp. Holy crud, that hurts really bad. I'm gonna crud. I'm gonna say A. Monica says A. I'm gonna say A. I'm just gonna kind of overrule you guys for now. And I was wrong. Medical expense insurance. See? Yeah. So I was thinking A because it was saying, yeah, I should have known it because of this medical expenses. But I was thinking disability insurance because of the accident part. Yeah. Yeah. And I always say that. I always say don't overthink it. And if the answer is in the question, go with it. Um, but I was just second guessing myself. Shouldn't do it. I say don't do that. So I was trying to, man, I got a really bad leg cramp. Um, I always say don't do that, and then I do it. Man, I don't have any. Have you ever heard of the thing about if you get a cramp, you take a like a shot of mustard or like dill pickle juice or something? Yeah. Well, I'll tell you what it is. Like, um, I drink zero pop, and it strips your potassium out of your blood. So don't do that. I drink a lot, but I drink the wrong things. Okay, it passed. It passed. All right, so let's move on from this because I don't like it. I was embarrassed by that. All right, so what is one characteristic of group life insurance? Higher premiums for each member, individual underwriting for each employee, benefits payable only after retirement, or a single contract covering multiple individuals. Low potassium will throw off your heart. Ugh. I wonder if that's why my blood pressure's been high lately. And it looks like everybody got this one. This one's kind of a duh. All right. So I'll hydrate properly. I'll stop drinking the wrong things. But I literally I don't I know the danger of like energy drinks and whatnot, but when I do these lives, I Like they help me stay sharp and be up. I always try to be up. An underwriter identifies an applicant as a substandard risk. The insurer may decline coverage immediately, require annual medical exams, charge higher premiums, and add policy exclusions, offer the policy at a preferred rate. Well, you guys are scaring me now. Get me some potassium. Yeah, you guys are all answering this right. My unwritten rule works, and yeah. Substandard risks are covered at higher cost or with policy exclusions to compensate for greater claim likelihood or having low potassium, apparently. So, I believe you. I believe you. What is the primary feature of an ordinary whole life insurance policy regarding premium payments? Oh, seriously? Great. Premiums increase with age. Premiums are paid only for a certain term of 10 years. Premiums vary based on investment performance. Premiums are level and guaranteed for the life of the insured. Unwritten rule. Let's look at the unwritten rule. Ordinary whole life, also called standard whole life, basic whole life, longest answer wins. Ordinary whole life insurance policy are designed with level premiums that remain same throughout the life of the policy. You guys are all focused on my health. Focus. I'll be fine. I'll be fine. So, level premiums remain the same throughout the life of the policy. Premium amount does not increase with age or based on other factors. Level premium structure. I won't read the rest of that. All right. Maria adds a spouse or / other insured term rider to her life insurance policy. What benefit does this provide? Coverage for accidental death only, term life coverage for her spouse, increased cash value for her policy, or an additional death benefit for her children. Yeah. So, yeah. Seems like a couple of these could apply. But I'm thinking it's B. I'm also thinking it's B. We got it. We got it. And the reason I don't think that it's D is because it's not really additional death benefits for children. So, but it does, an other insured rider does add term life coverage for either a spouse or children, but not additional death benefits. So again, that's reading the question carefully. So good job. You guys got it though. You guys got it. And also, well, you got it because you had everything in there, B, C, and D. So you got it. B was it. When you bet on horse races, you do win, place, or show. It's the guaranteed be right. In the third party ownership, the blank holds the rights to the policy benefits while the blank is covered under the policy. We didn't cover third party ownership, but I think the B's have it. Yeah, so basically third party ownership is like a parent having ownership over a child, like a juvenile's policy or a spouse's policy, or but yeah, it's B. So, and third party ownership, a policy owner is the person or entity, could be an entity that holds the rights to the policy benefits, while the insured is the individual whose life is covered by the policy. The policy owner pays the premiums and has the authority to make changes, including naming beneficiaries and altering changes. Here she says, I'm going to put life insurance on what family I've left. Yeah, that's smart. I'm telling you. I'm about to do a whole like screening of my entire family too. Seen too many bad things happen. Too many people having to get loans or do like GoFundMe's to pay for people's funerals and whatnot. So, um, yeah. So, cool. Looks like we all kind of got a good grasp of that. What is one characteristic of group life insurance? I think we already asked this in one way, right? A single contract covering multiple individuals, higher premiums for each member, individual underwriting for each employee, benefits payable only after retirement. I literally think that was asked exactly this way. So it's kind of like a duplicate, and we all should get that one right then. It doesn't even give us any explanation because we all should just know it, right? So what is the primary purpose of the suitability and annuity transaction? We'll skip this one because I think this is good under every one. Well, let's just do it. What is the primary purpose of suitability and annuity transaction regulation under Idaho law? I think it's everywhere. To limit the number of annuity products available, to confirm that the annuity transactions align with the financial goals and circumstances of the consumer. Oh, I'm thinking my rule's going to apply here, folks. To ensure the annuity transactions are profitable for insurance companies, to standardize annuity products across different insurance companies. Yeah, this is a process of elimination, and my rule both applies to this one. There's only one answer that really makes any sense, and some of them are so absurd. I like it when they throw them in because it makes it easier to answer the question. But like, no rule is going to ensure that an annuity transaction is profitable for the insurance company. They don't care about that. That's not what the state is there for. So, and that works for every place. And we already saw this one as well, but you guys should definitely get this one right. What does the spendthrift clause do? Literally, it was exact question. D. Literally, it was asked exactly the same way. So, a lot of duplication in this test. Okay, this is a new one. The primary role of the state in insurance regulation. This one works as well. To set the national insurance premium rates, to ensure insurers operate fairly and protect policyholders, to administer federal government insurance programs, to enforce federal insurance laws. So again, this one right here, my unwritten rule applies, and got to go by the process of elimination and read the question where it says state and then read the answers. It's B. Yeah. So states play a critical role in regulating the insurance industry, but they're not going to, the state regulators are not going to enforce federal laws. So national equals federal, federal equals federal, this equals federal. So this is the only answer that actually makes any sense. All right, we got 10 minutes or so to go. During policy delivery, the agent must ensure that the client understands all blank that modify the terms of the basic insurance policy. Riders, underwriting decisions, financial statements, or marketing materials. Yeah, so I think A or B is kind of what it comes down to. But yeah, I'm gonna go B. I'm going B. Final answer. And I was wrong. A. So, and I thought A possibly. Yeah. So riders are additional provision added to an insurance policy that modify the basic terms and provide extra benefits or coverage options. Now, here's the thing to understand. And I think that I think the reason this is just so you kind of fully understand, underwriting decision is not a term. Like that's not a term. So uh underwriting decision from a term standpoint would be exclusions. So if there are exclusions, you'd have to explain those. Provisions, you have to explain those. And then riders is an actual term. So that's why that's the right answer. And I didn't think it out fully. I'm not firing on all cylinders right now. But yeah, that, and again, I think, we learn a lot from our mistakes or whatever. I feel better. My, I think if I like move my foot right now, my cramp will come back. But yeah, I think it was good that we saw that, because yeah, we got to remember what we're doing. We got to stay in our lane. So I don't know. I want another like crude example. Um, is our local amusement park is Kings Island in this area. Um, I'll do that once I'm done here. My floor is cold. I don't know how you knew. I'm in the basement, so I'm in my lair, and my floor is cold. Also, I might do a spoonful of mustard when I'm done, because that works. That's so dumb that works, but it really does work. If you have trouble with cramps, take a spoonful of mustard if you can. I don't have any pickle juice, but I have mustard. So, but yeah, I've heard that as well. Um, but it's weird how that works. I'm telling you. Anyway, um, we have old fashioned cars at Kings Island, and they went away for a while, then they came back. But they have a rail that goes down the middle, so you can like literally let your kid drive, and the rail will keep it on the track or whatever. So when we're doing these testing, we've got to remember like terms keep us on the track. I've been to Cedar Point. It's been a few years, but I actually was at Cedar Point the first year. Shoot, which one's that called? That used to be the tallest. It's not anymore. Max. What was it called? Shoot. What was the name of that ride? Anyway, used to be the tallest. This was back in the 90s. Like that's how long ago this was. But I waited in line when that ride, with the first year that it came out. My brain is so fried. I usually can remember this. But 4 hours we waited in line to ride that ride. And it literally, like, the hill like looks like it goes under. And it's the one when you were at the top, you could literally see like Canada or something like that from the top of that roller coaster. But now there's a bigger one there. Yeah, I don't ride roller coasters anymore, but when I was a kid, I did. And I can't believe I can't remember the name of that one. XL, Magna XL. Crap. Anyway, help me out, Daniel. Um, let's see. I don't do it anymore, but I used to. I used to love them, but those days have passed. All right, well, let's see. This applies everywhere. We'll get through one or two more questions here. Lydia that's my daughter's name, is a newly licensed producer in Idaho. She submits her first insurance application for an insurer. What must the insurer do next? Provide Lydia with additional training, submit an appointment notice to the Idaho Department of Insurance within 15 days, require Lydia to pass another licensing exam, cancel her application if she does not yet have an appointment. So again, the unwritten rule works here. And this is again, this is good in every state. You guys got it, B. So an insurer must submit an appointment notice within 15 days. And that's another like question right there. It might be asked like, how many days do they have? Within 15 days of the producer submitting their first insurance application. So it might be asked like, how many days, or what do they have to do? And this will be the last one. We'll finish up right here. So under federal law, which entity sets the minimum standards for Medicare supplemental insurance? The National Association of Insurance Commissioners, the Department of Health and Human Services, Centers for Medicare and Medicaid Services, or state insurance departments. And I'm going to have to defer to Paulina on this one. Or Christy. I don't know. Didn't you guys both work in like healthcare or something like that? Am I thinking correctly here? I'm going to go with A though. There we go. The Omnibus Budget Reconciliation Act, OBRA, of 1990 requires Medigap policies, which we know that Medicare Part C are Medicare Advantage or Medigap. Yeah, me too. I'm absolutely done. So you're okay. You're just tired. I am too. Again, standards are set by the NAIC. And my rule applied. I don't really count that one though. But yeah, so you fished all day? Well, that's nice. So that's pretty awesome. I'm going to stop recording here.